Return as Disney CEO amid a string of disappointing results and a slumping share price. Plus, towering debts. Court papers show that Sam Bankman-Fried's bankrupt FTX owes its 50 biggest unsecured creditors more than $3 billion.
I mean, we have some pretty interesting stories today that we'll get through. This is a picture for the futures. As Tom was saying, it's all about concern in China and the fact that we could see this COVID-0 policy stop and start again. So there's definitely move to shelters, such as, for example, treasuries and dollar. And you can see pressure, DAX futures and FTSE futures down 0.3%.
Yeah, the move to shelters quite pronounced. Two key factors, as you touch on. It is China and it is concern about Fed hawks as well. We had that pushback from officials last week. But it's China's front and center and the complexities around moving away from COVID-0 just being underscored by what is happening in places like Shijiazhuang, which is about 180 or so kilometers away from the capital, Beijing. Currently, you're seeing the FTSE 100 down 0.3% as investors here digest that news. The CBI conference, by the way, underway in Birmingham. We'll be gauging the business reaction to that autumn statement of last week. The CAC current over in France down by 0.3%. The Spanish IBEX in similar territory off by 19 points. And over in Germany, the DAX down at this stage by 0.2%. Let's see how things are playing out cross asset. Then we look ahead to the US. US markets, US equities just ended the week lower. European equities just notching gains towards or for the full week. The context is you're gaining about 6% across the month for US equities. But today, futures pointing lower by 0.4%. Euro dollar under pressure because of dollar strength. That move in to the greenback 102 on the single currency, down by 0.6%. The benchmark at 381 on your 10-year, and just that inversion between the two tens remains pronounced around recession fears. And Brent, $87 a barrel. WTI, by the way, dropping below $80 a barrel for the first time since September. This again tying to the China story, concerns about demand, down by 0.4% on Brent. Francine.
Now, China may tighten, Tom, COVID curbs after a string of reported deaths, which has led to declines in Asian stocks and a bid for haven assets. That's exactly what we were talking about. So joining us now to unpack all of this for us is Enda Kern, our Chief Asia Economics Correspondent. Enda, good afternoon or good morning. We've seen a lot of optimism recently in China. That seems to have ebbed away with today's news. So what's the latest?
Well, it will be a big test of that optimism, Francine. As Tom was saying, this particular city, not too far from Beijing, was actually rumored to have been something of a pilot zone for how China might transition away from COVID. Well, in fact, we're getting news now of fairly severe restrictions there, an ongoing testing regime, something of a lockdown going in place there because of an outbreak. Now, what economists are saying is that obviously cases in China are continuing to hit multi-month highs. We're now getting news of fatalities, the first since that big Shanghai lockdown back in March, April, and of course we're heading into the winter season. So it's obviously going to be a big test of how China does try to manage its transition away from COVID-0. Now, to be clear, China is still sticking to very strict rules when it comes to managing COVID. It has its quarantine requirements, it has the underground testing and restrictions, so China has a long way to go. But of course, they have been signaling some softening of that regime by trying to target these measures. They're not going for mass broad-based lockdowns that damage the economy, but this news now of these spreading cases and the particular restrictions they're imposing in this particular city, for example, I think is a reminder of just how far China has to go, and it will be a test of the optimism for where China is at on the trajectory of moving away from COVID-0.
And Enda, briefly, when those who have exposure to China, those interested in the developments in China, looking very closely, of course, at COVID-0, but also the property market. And early this morning, we had some reaction, or at least an announcement, around further steps to try and support that part of the economy, that sector. What do we know? What are the details?
So this came from a meeting between the regulators, including the central bank, Tom, with some of the big lenders. The essential message was there were some technical measures rolled out, including ensuring there is sufficient support for those who are borrowing in the real estate market, ensuring there's sufficient credit and liquidity for those who need it to ensure the housing sector keeps ticking over. The backstory is it gelled with recent measures from the government, that recent 16-point plan, where they're rolling out steps to put a floor under the housing sector, and economists say this could prove to be a game changer for that part of the economy over the months ahead.
Okay, excellent. As ever, Bloomberg's Enda Current out of Hong Kong on the latest when it comes to the property sector and the challenges around implementing some of those easing measures around COVID-0. Joining us now is Klaus Bader, Global Chief Economist at SocGen Corporate Investment Banking. Klaus, good morning to you on this Monday morning. On China, you say in your notes to us that you're becoming more certain that China does reopen in 2023. What would that mean for the European economy, a reopened China?
Well, it would mean, first of all, that there's a reduced risk that we get, again, intensified supply chain issues. I think that's one. And the second one, too, is, of course, that it's going to be good for private consumption. I mean, as we've seen in recent data, retail sales, for example, the threat of lockdowns, of course, has made Chinese consumers very hesitant. Now, you know, as far as goods are concerned, Chinese consumers, of course, primarily consume goods that are made in China, but not exclusively. It's, of course, a huge market for luxury, for European luxury producers. And so it would be good news if China reopened, that's for sure.
Klaus, how quickly do you think we'll get to a reopened China that can sustain the world economy? There are also huge concerns about property and maybe asset bubbles.
Well, I'm not so sure about the asset bubbles. You know, they're always in the eye of the beholder. The real estate is definitely going to be a long-term story. You know, the demographics alone in China suggest that real estate is not going to be, and the real estate sector isn't going to be anything like the support it was for economic growth in China. And so I think China, in that sense, will have entered a much slower trajectory of economic growth. But I think as far as reopening is, you know, they're going to be very careful through the winter. Winter is always a more dangerous period for COVID, for flu, for all of these infectious diseases. So it's going to be, you know, sometime early in 2023 when China really does reopen and really permanently, or hopefully permanently, lastingly relaxes all these restrictions.
Okay, so we look to early 2023 as we, in the moment, the here and now, see how complicated it is to move forward on that front for Chinese officials. When it comes to the trade component, Klaus, exports such a key driver, particularly through the pandemic, for that economy. What is the data telling you now about the resilience of China's export sector?
Well, you know, there is, you know, clearly global trade has benefited from the shift of consumers away from services and towards goods. And, you know, that shift, I think, is unwinding gradually. I mean, trade has been, a good trade in goods has been remarkably resilient, much more resilient than people expected. And that's because demand for goods didn't fall off a cliff once people, you know, had bought their new IT equipment and maybe some new furniture, etc., as people shifted towards working from home and homeschooling and all these things. But what I definitely see is that there's now a shift of poles, i.e. a shift of strength, because China and a few other Asian economies, right, Taiwan, Korea, very, very strong in IT. And those things were, of course, very much demanded. And so I think global trade is going to be fairly resilient, but we're seeing a shift away from Asia.
Overall, do you think we've touched peak inflation in the US and elsewhere?
We're very close. You know, when you look at upstream price indicators, be it energy, be it transportation costs, all of those things, food that have pushed inflation up, they're all rolling over or have already rolled over. So I think we're probably at very close to peak inflation. In the UK, it's probably around the turn of the year, the first quarter of next year. But at the same time, I think that doesn't mean that we're going to now swiftly go back to 2%, because in my view, what has taken over now, rather than upstream price pressures, is wage costs. And in Europe, the big wage acceleration is only just beginning. In the US, I distrust the signs of slightly weaker wage growth.
Certainly in the UK, we're looking at strikes because a lot of people want their wages put up. Klaus, thank you. Klaus Bader, the Global Chief Economist at Societe Generale Corporate Investment Banking, stays with us. Coming up, a bit of a humble pie. Central banks seem to be accepting they did not act as fast as they could do to control inflation. So we discuss that next. This is Bloomberg.
There is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then dissuade you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
Welcome back to the Open, everyone. 11 minutes into the European trading day. This is a picture across the board. The stocks falling, as Tom was saying. There's a lot of concern on China, the fact that they may tighten COVID curbs after a string of reported deaths, and of course the impact that has not only on inflation across the world, but also on just the world economy.
Yeah, absolutely. So that anticipation that we saw last week of maybe some of those measures being eased, and we know that officials put out this 20-point plan or so, and just the challenges in terms of implementing that when you have soaring cases. So that is a conundrum for officials in Beijing.
And then we look every day about who's right. Is it equities or actually bonds? So central banks desperately trying to rein in inflation, an inflation problem that was allowed to spiral out of control. That's eroded their credibility in the eyes of investors and society at large. Well, Larry Summers is the latest to blame the Fed for dragging its heels.
I think that the Fed has this in the right place when it says that they're going to move up somewhat more and they're going to take stock of the situation. I have to say that if they hadn't made as many mistakes as they did of excessive optimism about inflation, they'd probably have a little more room than they do.
I mean, I don't think I've ever heard Larry Summers actually say anything good about any central bank, to be fair.
Yeah, well, he was out front. He was out front, right, with his calls that they were not going quickly enough. They needed to address it. They need to raise rates. And there he is, again, saying they still have some work to go.
Yeah, so if you look forward, what can they do to correct the course? Let's get back to Klaus Bader, Global Chief Economist at Société Générale Corporate and Investment Banking. Klaus, if we assume that central banks were wrong, although, inflation did come in quite thick and fast, what do they now need to do to make sure that people believe them, that they're credible?
Well, they don't really have a whole lot of means, do they? I mean, they have to, of course, pursue interest rate normalization, arguably go to a stance that is somewhat restrictive, and they have to unwind their balance sheet, so take away that stimulus. But yeah, I mean, it wasn't just the Fed. I would say the Fed wasn't nearly the worst. I'd say that probably the ECB takes the cake when it comes to being late and fooling itself into this narrative that inflation was temporary. You know, I looked at, as I was writing our latest global economic outlook, it was in June 2021 when we were already writing that monetary policy was completely out of whack with economic reality. So this was obvious for quite a long time.
And Klaus, the chorus in terms of what we're hearing from Fed officials and others who watch the Fed are looking at a terminal rate of above 5%. What does that do to your view around the relative resilience of the US economy?
Well, we think that the economy does have quite a lot of resilience, and there are a few factors behind that. I mean, the most important for me is definitely all these what I call excess savings. You know, households saved enormous amounts of money during the COVID crisis. Now, American consumers have begun to dip into those excess savings, but in Europe they really have not, or at least as far as they have data. In Germany, they probably did in the most recent quarter, i.e. that we know of the third quarter. But I think that gives a whole lot of resistance to the economy. And with yields and earnings as high as they are, you know, I think that the economy is unlikely to fall into a big black hole. I mean, we think that the concerns about U.S. recession are, you know, either overdone or overblown, or at least premature. We don't think that the U.S. economy is going to meet recession before, you know, maybe early 2024.
Klaus, we talk about the tensions, which Tom and I love talking about, you know, what the bond market gets right or what it gets wrong. And, you know, a lot of people think that the bond market in general is just a lot smarter about what the Fed needs to do and what it's going to do. At the moment, they're basically telling us that they won't be able to get its rates up to 5%, nor will it need to. Are they right?
I'm not 100% sure why you think that the bond market is saying that. It's certainly saying that that period is going to be relatively brief because we still have, of course, long-term yields which are significantly below 5% or just above 5%, where we think Fed funds are going to go. You know, I'm a little bit skeptical about this level of long-term interest rates. I think we've just gotten used to in the last 10, 15 years to these very low bond yields. And I don't think it's completely unlikely that we're maybe going to go back to bond yields, which we used to consider normal before 2010. So yields that are somewhere in the 4 to 5% range, and that they're going to stick around in that region. I think that's definitely possible. And to my mind, the demographics also point in that direction. But that's a big topic, and people disagree on that quite a lot.
Yeah, I guess the reference there was to the US 10-year. Of course, the yield has come down fairly precipitously over the last few weeks. It was at, what, 420, currently at 381 on the 10-year. Klaus, when it comes to what's happening in the UK, you also have a fairly nuanced view. I mean, with a lot of hand-wringing, a lot of anxiety on the back of the autumn statement, and pretty dire predictions from the OBR last week. But you don't think the recession is going to be too calamitous here in the UK?
Well, we think, you know, that we definitely think that the recession has already started. We think that it's a recession that's going to drag on for quite a long time. You know, a 4 or 5 quarter recession. That's a long recession. Yeah, but it's true. We don't think that there's going to be, you know, a complete collapse and that it's going to be a terribly deep recession. And, you know, I come back to the point that I made earlier. In the UK, you also have these enormous household savings. And so household balance sheets are certainly in all those economies where fiscal policy has been very active. Household balance sheets are incredibly healthy, and that should help cushion the economic pressures, and in particular, in the UK, the interest rate pressures. The UK is exceptional too, I think, in its fiscal pressures. There's a lot of fiscal consolidation pressures. And then, you know, let's not forget, there's Brexit, which is economic poison.
The economic poison of Brexit. Klaus Bader, thank you very much indeed, Global Chief Economist at SocGen Corporate and Investment Banking, for joining us on the US economy, what is happening in China, the implications and the read across to Europe as well. Thank you. Right, coming up, 3.1 billion. 3.1 billion. That is how much FTX owes in dollars to its 50 biggest unsecured creditors. We have got all the latest next. This is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Welcome back to the Open, everyone. We are 21 minutes into the European trading day. This is a picture for European stocks. They're down between 0.2 and 0.4%. No matter, what we need to talk about is the Swedish housing market. I know Tom and I, especially Tom, really want to talk about this. Now, the reason why this is important, because we're seeing a rout, and usually these are just hiccups, right? Sweden has been pretty much stable, and so the fact that there's a huge rout could spell big trouble ahead for other countries.
Right, and exactly. Whether it's the canary in the coal mine for the broader global housing market, and you're talking about, and you're looking at places like Australia, New Zealand, here in the UK, of course, as well. So 7 straight months where housing prices have fallen in Sweden. Some house prices have dropped by as much as 14%. So again, given what is happening in Sweden, they had a big run-up, particularly during COVID. We saw that in other markets. How much of this is a nod to what may happen in places like the UK, where some economists have looked at potentially downside of as much as 20%. But I know you're fascinated in just how to build a house in Sweden,
You
right?
buy them on a catalog, which I'm obsessed by, but on a more serious economic point, a lot of young people there have never experienced a housing market crash, which people here in the UK have, and at the same time, corrections have been shallow and very short-lived. So one to watch. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. Walt Disney is bringing back former CEO Bob Iger to run the company. The 71-year-old spent more than 4 decades at Disney, including 15 years as chief executive. The company says he's agreed to serve for 2 years, succeeding Bob Chapek, who is leaving immediately. Disney shares are heading towards their worst annual loss since at least the 1970s. The IMF says the rise of trade barriers against China and other countries over the past year could cost the global economy $1.4 trillion. Fund manager Kristalina Georgieva says the potential loss for Asia could be more than 3% of GDP because the region is more integrated into the global value chain.
The world is going to lose 1.5% of GDP just because of divisions that may split us into two trading blocks. This is $1.4 trillion. For Asia, the loss is much more significant because Asia is so integrated in global value chains. It could be 3% or more.
That's your Bloomberg Business Flash. Tom, Francine.
Alice Atkins, thank you very much indeed. Now, crypto prices continue to fall in the ongoing crisis sparked by the downfall of Sam Bankman-Fried's once powerful FTX empire. Over the weekend, it emerged that FTX owes its 50 biggest unsecured creditors a total of $3.1 billion US. Let's bring in Alex Webb then, who leads our tech and media coverage from Bloomberg. A quick take. Alex, just every day, every 24 hours or so, we get an update in terms of the turmoil inflicted on these crypto markets by SBF and the downfall of FTX. What is the importance around the creditor situation? $3 billion US that's owed.
If there are a lot of companies, and it seems like there are 50 companies named there with between them sizable amounts of capital invested through FTX, if a significant part of their resources is in that, then it has risks of contagion for their balance sheets. Do they have enough capital to survive? Even if they do have enough capital to survive, does that mean they need to sell down assets elsewhere? That then has other implications for the prices of Bitcoin and other cryptocurrencies. So there's a lot of things we don't know that could be creating bigger problems for the space.
Alex, I have a rather bizarre question, but actually there seems to be so much space on what's going on with Twitter, and Elon Musk is tweeting every 2 seconds, that the media has like wall-to-wall coverage on Twitter. Are we not spending enough time talking about FTX? Like, which is the bigger story?
Well, the cover story of Business Week this week is about FTX. I certainly think at Bloomberg we're giving it plenty of attention.
Course,
I generally think that there's way too much coverage of Twitter as a whole because, yes, it has a certain amount of influence when it comes to election cycles and things in the US, but ultimately it is a small company in the grand scheme of things when it comes to Silicon Valley. It's 250 million users. Its revenue is less than BT's profit, right? Pre-Elon, we should say. We should assume right now it's getting even worse. So, it has an outsized influence when it comes to the thing that venture capitalists and Web3 enthusiasts are super enthusiastic about. It is the broader crypto space. This is having big implications for that. Now, some of the optimists, Vitalik Buterin, for instance, they've found one of the leaders of Ethereum. He's saying, well, this shows why decentralization is actually important, because when you have any sort of centralized institution of some sort, then things start to go awry. So inevitably, the crypto Web3 enthusiasts are sort of saying, well, this is it reinforces our thesis rather than detracting from it.
They're very, very good at pivoting on a crisis, aren't they? When it comes to the question of Twitter, and it was interesting your point on the relevance. I think a really important question as well. And so Martin Sorrell just pointing to us when we spoke to him about how minuscule it is when it comes to ad revenues. Just very briefly, reinstating President Trump, the controversies there, more advertisers could pull.
If they haven't pulled already, a lot of them are already pulling back. I guess this is the question of whether they're going to come back. And if he is going to bring in a certain sort of audience and there's not going to be enough calling out of untruths on Twitter, which if they're tamping back on the kind of quality team, then that is a risk, particularly as we head towards the election.
Alex, thanks so much. Alex Webb from Bloomberg. Quick take. Coming up, we're live at the CBI conference where the Prime Minister is set to address the UK's biggest business group. That's next. This is Bloomberg.
been an advisor to the President of the United States on infrastructure and manufacturing, but on infrastructure, you've been involved with the legislation that was passed not long ago. Why is the United States infrastructure so terrible compared to so many other wealthy countries?
I have been around US politics like you for a couple of decades and have served a variety of presidents from the different parties. And the attitude in the United States is obviously to keep taxes low and keep the public spend under control. And the word control is interesting, but that stops forward thinking in terms of planning. And therefore, the short-termism around our fiscal policies has hurt us. I mean, in essence, infrastructure is a long-term return. And to get a long-term return, putting it into private hands is one way of doing it. But really, the public side of life has to be willing to do the forward spend. The forward spend on airports and roads and EV charging stations has to come from the public domain. Now, raising taxes to spend money on infrastructure means you've got to trust the people doing the spending. And I think the public-private model is the way to go there, which is actually create an infrastructure bank that is US public sector owned that has private sector matching funds. I think that sort of breakthrough has yet to occur in the United States. So where we go is tax and spend, which unfortunately one side of the aisle disagrees with.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. COVID-0 concerns. Stocks drop, treasuries on the dollar gain as Beijing tightens curbs amid a resurgence of the virus, including the first fatalities since May. Seeking the old magic, Bob Iger makes a surprise return as Disney chief executive amid a string of disappointing results and a slumping share price. Plus, towering debts. Court papers show that Sam Bankman-Fried's bankrupt FTX owes its 50 biggest unsecured creditors more than $3 billion. So, Tom, if you look at the markets, they're going to safe havens, not because of FTX, although maybe at the margins they're looking at that. Really, they're looking at China.
Yeah, they are indeed. Yeah, looking at China. That is a catalyst, clearly, the hawkish speak from Fed officials. We look ahead, by the way, to Fed minutes out later this week to kind of flesh out the thinking from the central bank of the US in terms of where they go with rate hikes. Of course, markets still pricing at about 50 basis points come December. The benchmark here in Europe, looking at losses of 0.2%. Over in Germany, a drop of 51 points, trading at 14,380 on the DAX. That's down 0.3%. Here in the UK, we are at the CBI conference. Lizzie Burden's there gauging the reaction from the business community to that autumn statement. The FTSE 100 currently down 30 points, off 0.4%, trading at 7,354. Let's switch it over, look at the sectors and how things are playing out then, particularly with the energy space. Very interesting to see the moves in iron ore, particularly Brent and WTI as well. WTI, by the way, below $80 a barrel for the first time since September. Brent under pressure as well, of course. Utilities, so a safe haven, of course, sector, gaining 0.5%. Down at the bottom, you've got basic resources, again, tying very clearly to that China story, the concerns about COVID, the rampant surging number of cases, currently down around 2%, 1.8% on basic resources. Iron ore being hit particularly today on the back of those concerns about the demand out of China as it wrestles with how to exit from COVID-0. Francine.
Now let's turn to the UK. After unveiling a £55 billion package of tax rises and spending cuts last week to restore the confidence of markets in the economy, the government still has one large stakeholder left unconvinced by the autumn statement, and that's British business. Rishi Sunak will have the opportunity to address some of those concerns today when the PM speaks at the CBI's annual conference in Birmingham. Well, joining us now is Lizzie Burden, live at the conference with a guest. Hi, Lizzie.
Hi, Francine. Well, I'm joined in Birmingham by Mark Stanland, UK Director of Hayes. Mark, thank you so much for joining me. We've just been speaking to Tony Danker, the CBI Director General. He says that fixing the labour market in the UK isn't all going to happen overnight just through closer ties to the EU. Do you agree with that?
Yes, I do. I think we need a long-term growth plan.
There's a major skill shortage here in the UK at the moment. Businesses want to know how we're going to solve that skill shortage so that we can grow our businesses in the future. 93% of employers that we recently surveyed said that they want that skill shortage really dealt with, because a lot of them want to recruit more staff in the next year. Despite the current economic outlook, they're really keen to see that problem solved.
Well, if not Brexit, what's causing that skills crisis?
Well, I think it's been an accumulation of things. I don't think it's just Brexit. I think there are big geopolitical things that have happened that we all know about that have caused where we are at the moment. But what we need now is certainty. We've had a lot of uncertainty over the last few months. What business needs is certainty over the next year, the next 2 years, the next 3 years, so that we have a good platform to build on to look to the future.
And did you not get enough certainty from the autumn statement from the Chancellor?
I personally felt that was a good start after the sort of slight chaos that we had over the last 6 months. So it's a good start that we can build on. That's what employers want. We want to see a government that gives us that certainty so that we can plan and invest for the future, because investment is something that has fallen off over the last year.
And when you've got employers desperate for skilled workers, some of them are having to pay more. Are you worried about a wage price spiral in the UK?
I think in the last year, 83% of employers, again from a survey we've done, have increased their salaries, which is almost double what they did last year. So I think all employers have felt the need to increase their salaries. Number one, in order to be competitive, but also to help people with the cost of living crisis. The average wage increase that we've seen across about 10,000 salaries we surveyed was 5.4%. That is behind inflation, but it does show that employers are trying to increase their salaries as much as they can.
And though perhaps not maybe with Europe, is there more to be done on visas to improve conditions in the labour market?
I think what we do with visas is an ongoing debate. I think all employers want to access talent, so we'll want to look to what talent we can get from overseas. But that is always a short-term solution. We need to take responsibility for building our own skills in the UK, and that is the challenge for government. Can you come up with a really meaningful long-term solution? And my own view is that's a challenge that's been going for 20 years and still hasn't been cracked.
And the Prime Minister, Rishi Sunak, speaking at the CBI conference later today, he says that one of his top priorities is skills education after inflation and controlling illegal immigration. Are you convinced by that, or is it just talk?
I don't think it's just talk. I'm sure Rishi actually does mean that, but I think as with previous prime ministers and governments, it's about putting something in place that has substance, that really does land, starting with in schools, putting a plan in place that really engages young people in the workplace. I think whilst we've made a good start there, there is so much work to do. We at Hayes are also involved in that, but we know there's great potential to do something there, as well as providing short-term solutions.
And the Labour Party's been on the charm offensive, trying to bring companies round to its cause. Are the Conservatives still the party of business?
I'm not going to take any political view or opinion on that, Lizzie, to be honest with you. I think all governments need to do, in the future, whoever is in government in the next 5 to 10 years needs together to give us this certainty that I referred to earlier.
And so if you were advising the Prime Minister, what's the one thing that Rishi Sunak could do to move the needle and generate the kind of growth that Margaret Thatcher had with the Big Bang?
I think growth is the key word there. I do think with the challenges that we have at the moment, getting the right formula to deliver that growth is a challenge that I don't envy, but it is coming up with something where we can see that we can deal with the issues we have at the moment, but actually get investment going in business. Business will invest when they feel confident in the future, and I think if we feel that confidence and we can see that, that will come through, and then we will see growth come.
Is the tax landscape now, after the fiscal statement, too restrictive to encourage investment?
I think it's too early to say on that. I think that the government has decided to do what it's decided to do on tax. I think business wants to grow and therefore will take into account the challenges that those tax changes have for them. I don't think it will stop business investing if they feel certainty in the long term.
Mark Stanland, UK Director of Hayes, thank you so much for joining me. We'll have to see whether Rishi Sunak pays heed to that advice in his speech later today. Back to you, Tom and Francine.
Lizzie Burden in Brum for us. Thank you very much indeed at the CPI conference, of course. Now, coming up, COP done, World Cup begins. We will report from the Middle East next. That's as Egypt wraps up the 27th Climate Conference in Qatar, kicks off the 2022 World Cup. England playing later today. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
We're in the early stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
Welcome back to the Open, everyone. We are 41 minutes into the European trading day. A bit of pressure, of course, on these European stocks. This is mainly to do with what's happening in China, and we saw a definite risk reversal, a lot of money going into havens such as Treasury and dollars.
Yeah, briefly touching on a couple of corporate stories for you. So Virgin Money, of course, listed here in the UK, they have announced a £50 million extension of their share buyback program, and their results beat. And look at that, being rewarded by investors, up 11% in that stock, trading up 15 points. Vallourec, very different story for this tube, steel, metal tube maker, Vallourec, based in France. Currently off, as you can see, about 11%. It was a miss on their third quarter earnings. And HelloFresh, some upside for this company then, 2% gains. This is on the back of an upgrade in terms of their rating by Goldman Sachs. Now a buy rating on this online grocer listed over in Germany, gaining 2% on the back of that. So a couple of corporate stories just to bring to your attention. Okay, it has been a big weekend then for the Middle East. Negotiators at the UN COP27 Climate Summit did finally reach an historic last-minute deal after missing the deadlines on payments for climate damages, wrapping up events in Egypt. The baton handing over immediately to Qatar with the culmination of a 12-year build-up to a World Cup that, of course, has been marred by controversy.
Now, for our Middle East wrap, let's get straight to Bloomberg's Jennifer Zabazaja in Sharm el-Sheikh and Simone Foxman in Doha, two very different stories, two very important stories. So Jen, what's actually been agreed regarding this new fund at COP?
Yeah, Fran, I think the key word that you just said there is new, and that's what a lot of developing nations were hoping for coming out of this COP. So it is a new agreement to establish a loss and damage fund for developing nations. That is what was agreed upon. What was not agreed upon was the terms of this deal and what it will look like. Who are the countries that are going to be a part of this fund? Who is even considered developing in this day and age? Because when the UN first started this framework back in 1992, China, Saudi Arabia, and other major countries were considered developing. And of course, today, that is not the case. So what needs to be figured out as part of this loss and damage fund is how is it going to work? How is it going to be classified? And then they'll start to figure out how much is going to be included and when these disbursements will actually start happening. So there is a committee that is going to be set up starting in March of 2023 to start working this out and, of course, get things hopefully moving in the right direction heading into Dubai, COP28.
And Jen, of course, it was a compromise. It was a tortured compromise. It was messy. What has the reaction been from climate activists and from those in the business community and indeed policymakers around this eventual deal?
Right. I mean, depending on who you speak to, it's a different reaction. Mainly from policymakers, what we heard, let's just start with someone like John Kerry, right? He's been on the ground here for the past 2 weeks, saying that this was a successful COP, congratulating Egypt for the progress that we did see coming out of it. Of course, the U.S. and China did reestablish communications talking about climate. But when you talk about the 1.5 degrees Celsius, the goal that we want to keep the world below that degrees, there's a little bit of disappointment that there wasn't any stronger language put into this final cover decision from Glasgow. There were a lot of fossil fuel lobbyists reportedly here on the grounds and working to not include that bold language of phasing out all fossil fuels. And so a lot of people were pretty upset about the final language not being stronger, not being bolder, not getting us closer on this path to keeping below the 1.5 degrees.
All right, Jen, thank you so much. Simone, so you're at the World Cup, and it's not really about football. It's, first of all, about all of the controversies, and also the president of FIFA with a pretty incredible press conference over the weekend.
Yeah, very strong statements in support of the Qataris and essentially against some of the criticism they've been receiving. But some of that controversy has focused on what might happen on the ground. How will security officials deal with drunk fans? How will they deal with people who walk around waving rainbow flags? And frankly, we haven't seen that. If you go out to the fan areas, the fan festivals, they've been pretty empty. I walked around yesterday afternoon. Part of this may be because the first match, the opening match between Qatar and Ecuador last night was pulled a day earlier, late in the game, after most people had already made their travel plans. We're also going to be watching very closely the England-Iran match. A lot of interesting matches today, but that's the one where there's probably a lot of political controversy. There are massive protests going on in Iran. The team, this Iranian soccer team, typically co-opted essentially by the regime for national fervor, and that's a very divisive issue. At the same time, we'll see Harry Kane, whether or not he wears this One Love armband representing LGBTQ rights, even if he faces fines and a booking because of it.
Yep.
All right, scrutiny on Harry Kane and how he maybe potentially pushes back on some of these rights abuses that have been flagged in Qatar. And talking of those abuses and the controversy, how have those corporate sponsors kind of reacted to the whirlwind of controversy and hand-wringing and angst around this event?
Yeah, this is a really good question that I was struggling with, because this is the most controversial World Cup probably in recent memory. And over the last couple of years, corporates, brands have embraced social impact and ESG. But I got in touch with 76 brands sponsoring either national teams in the US, Canada, and Europe, where criticism has been widespread, or FIFA sponsors based in those areas. Very few of them told me that they are changing their marketing strategy in any way because of some of the human rights issues that Qatar has faced. 13 of them ultimately said they were, but only 3 of those 13 actually had even tenuous business ties to Qatar. So brands talk big about ESG, but in reality, when it comes to ad dollars, when it comes to billions of eyeballs, they don't seem to be doing quite as much.
Yeah, indeed. So we have England, Iran later today, and then Wales, USA as well, around 7 p.m. UK time, I believe. Thank you very much indeed to Moon Foxman, who is on the ground for us at the World Cup. Jennifer Zabazaja, of course, finalising and putting a bow on the end of 2 weeks of talks over in Sharm el-Sheikh in Egypt. Let's get the fullest word news now with Alice Atkins. Alice.
Hi, Tom. A city near Beijing that was rumoured to be a test case for removing virus restrictions across China has asked residents to stay at home for 5 days. A potential sign officials are reverting to tighter COVID-0 curbs. Meanwhile, the country's first COVID-related death in almost 6 months has sparked concern that Beijing could see a return of restrictions. The report comes amid a continuing outbreak in the capital. Malaysia's political leaders now have until 2 p.m. Tuesday local time to decide on a prime minister. The king has extended the deadline by 24 hours after Saturday's vote resulted in the country's first ever hung parliament. Opposition leader Anwar Ibrahim says he has the numbers to form a government despite falling short of a simple majority. The UK government says it isn't seeking a new Swiss-style relationship with the EU. The pushback comes after a Sunday Times report that Prime Minister Rishi Sunak's administration is exploring closer economic ties with its European neighbours. Switzerland is a member of the European Free Trade Association and participates in the single market for most goods. The UN's atomic agency says powerful blasts have shaken the area around Ukraine's Zaporizhzhia nuclear power plant. The IAEA says some buildings and systems were damaged, but none critically. Ukraine's nuclear regulator says Russian forces struck the facility. Moscow blames Ukraine for the shelling. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Tom, Francine.
Alice, thanks so much. Alice Atkins in London. Now, coming up after a fairy tale farewell 2 years ago, longtime Disney chief executive Bob Iger returns to lead the entertainment giant. We'll have all of the details next, and this is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilisers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertiliser helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question. Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Welcome back to the Open, everyone. 52 minutes into European trading day. Still a bit of pressure on European stocks with the DAX down 0.5%. All eyes on China. Disney says former chief executive Bob Iger is to return to his old job effective immediately. Well, Iger stepped down as chief executive in 2020 after leading the company through a period of enormous growth over 15 years. He remained on the board of directors for another year. Well, joining us now is Rachel Chang, covering Disney. We also saw a share price, actually the ADR here in Europe, getting some 6.8% at the open. Why has Disney brought Bob Iger back, Rachel?
Right. I mean, I think it's no surprise that the CEO that's just been ousted, Bob Chapek, has not been doing that well. Disney has had a very rough year. Its streaming platform is looking shaky with enormous losses. Its stock price is down 40% in 1 year, which is really the most it's ever dropped in pretty much since the 1970s. So, I think it's not a surprise that Disney will be looking for a new leader at this time. What is a surprise is that they will be turning to the previous guy, Bob Iger, who was obviously a very high-profile, very successful CEO. And to some extent, turning to the old guy right now speaks to another problem that Disney does have, which is that it doesn't have that bench of leadership talent. It doesn't have a bench of succession. That's going to be one of the challenges that people will be looking to Bob Iger to fix.
And that was, yeah, Rachel, absolutely. That was a key question, wasn't it? Towards the end of his reign, Bob Iger was who is going to replace you? And they kept extending his contract and extending his contract. And look, you've touched on some of this. What are the challenges that Iger is going to face now he's back in the hot seat?
Right, exactly. And I think the immediate thing that the people are going to want to see from Iger is, a stabilization of Disney's two most important businesses. That's theme parks and the streaming platform. We know the streaming platform is still unprofitable. It's very competitive, 1.5 billion in losses in the last year. They've been saying that they want that platform to be profitable in 2024. People are going to want to see that. At the same time, the theme parks are not bouncing back to the same sort of revenue that was expected post-pandemic. That's going to be really another important thing for Iger to stabilize. And, what you said as well, people want to know what's next, right? Because the problem is, when will Disney ever get past the age of Iger? Is it always going to be circling this guy? Is there no other leader capable of bringing it to the next chapter? That's also going to be an existential question for the company.
So, Rachel, can you give us any insight? Is this because Bob Iger is a genius of business, or is it because the other guy was just no good?
I mean, Bob Chapek, a string of missteps. Everybody knows the thing with Scarlett Johansson. He's made a lot of gaffes, the Florida Don't Say Gay bill as well. But Iger, I think, is very closely associated with Disney's glory days, right? 15 years of uninterrupted growth. They bought Marvel, they bought Pixar. They just became this enormous company under Bob Iger. So there's this attachment to him as somebody who's going to steer Disney back onto safe ground. But at the same time, what he's facing ahead is so different from the past. Now it's all about streaming. The strategies that he used in the past are no longer relevant now. So the question once again is really, can Disney chart that new future? Can Disney find that new direction beyond what Iger used to do?
Okay, really excellent context. Thank you very much indeed. Bloomberg's Rachel Chang on, of course, the story around Disney, the change in leadership back to Bob Iger. Let's check in on the markets then before we let you go. You're currently seeing losses of 0.3% across the benchmark futures. In the US, also lower by around 0.5%. Yes, it is China and the concerns around COVID, the inability to extract themselves from COVID zero. And, of course, we're looking ahead to the FOMC minutes later this week, following those officials and their hawkish comments. Francine.
Now that's it for the European Market Open. Surveillance Early Edition is up next. We'll continue covering the UK, the Brexit debates, and of course, markets for the moment lower, as Tom was saying. This is Bloomberg.
digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
This is Bloomberg Surveillance, Early Edition, with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Here's what's coming up on today's program. COVID-0 concerns. Stocks drop, treasuries and the dollar gain as Beijing tightens curbs amid a resurgence of the virus, including the first fatalities since May. Seeking the old magic, Bob Iger makes a surprise return as Disney chief executive amid a string of disappointing results and a slumping share price. And historic agreement, negotiators at COP27 reach an 11th hour deal for a fund that compensates developing nations for climate devastation but falls short on fossil fuels. We're live in Sharm el-Sheikh. Now, good morning. First of all, let's check on the markets. All, of course, about what the Fed does, but also China concerns after we see that China may tighten COVID curbs after a string of reported deaths. This is also having an impact on European stocks, down 0.2%. The U.S. 10-year yield, we did see this move into risk havens, such as treasuries, but also such as dollar. The U.S. 10-year yield at 3.8119, and then sterling 1.1820. Now, the one story we also need to keep an eye on is Disney. It came as a surprise to a lot of people that they decided to bring back the chief executive that left 2 years ago. Just on the back of that, we don't have any announcement of what he'll do to put Disney back in shape, but actually the stock price in German trading is up 10%. Now, the picture overall for Europe, and there are a lot of country-by-country concerns, or certainly stories that are different from one another. Now, the IBEX over in Spain is gaining 0.3%. Here in the UK, the Prime Minister will also be in Birmingham addressing the CBI. Our Lizzie Burden is there on the ground for us. There was quite a lot of debate on whether they were looking for a Swiss-style agreement. The Brexiteers came up in arms over the weekend. CAC 40 down to some 0.3%, and then the DAX down 0.5%. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. Malaysia's political leaders now have until 2 p.m. Tuesday local time to decide on a prime minister. The king has extended the deadline by 24 hours after Saturday's vote resulted in the country's first ever hung parliament. Opposition leader Anwar Ibrahim says he has the numbers to form a government despite falling short of a simple majority. The COP talks in Egypt have ended with an agreement to help developing nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. The UK government says it isn't seeking a new Swiss-style relationship with the EU. The pushback comes after a Sunday Times report that Prime Minister Rishi Sunak's administration is exploring closer economic ties with its European neighbours. Switzerland is a member of the European Free Trade Association and participates in the single market for most goods. The UN's atomic agency says powerful blasts have shaken the area around Ukraine's Zaporizhzhia nuclear power plant. The IAEA says some buildings and systems were damaged, but none critically. Ukraine's nuclear regulator says Russian forces struck the facility. Moscow blames Ukraine for the shelling. Global news, 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Alex, thanks so much. Alice Atkins here in London. Now, China may tighten COVID curbs after a string of reported deaths, which has led to declines in Asian stocks and a bid for haven assets. We're now joined by Trevor Greetham, head of multi-assets at Royal London Asset Management. Trevor, thank you for joining us. I mean, the market's definitely concerned about what's happening in China after we were expecting COVID zero to be relaxed a little bit. What kind of China does the world economy and world markets need?
It's a really good question, and I think it's maybe a bit counterintuitive, but we're still in this kind of topsy-turvy world where good news is bad news because the markets are still really sensitive to interest rates and where the peak in Fed funds would be. And in our team, certainly, we're talking about a possible reopening of China next year as something that could keep inflation high, keep interest rates rising, and therefore being bad for stocks. So it's a bit of a strange one, actually. Yeah. That it's bad for earnings if China is shut down, but it's actually good in terms of the peak of interest rates.
Yeah, so it is all about what the Fed does, and of course, where we see peak inflation and interest. Where do you expect the terminal rate to be for the U.S.?
Oh, it's really hard to say. I mean,
how often do you get asked that? Hourly?
Well, I think it's one of those things where you look for the signs of what will cause the Fed to pause, and in my view, they'll either pause because unemployment has started clearly rising, and you know what unemployment does. It gradually moves lower during an expansion, and you're waiting for that moment when it cracks. But when it cracks, it cracks. You know it when you see it. So we're waiting for that moment when the Fed is likely to pivot because of either rising unemployment, or maybe there'll be a credit event that will cause them to step back. But we don't see either of those things yet.
And so that means that what we're going to see, I mean, have we reached peak inflation? And when we've reached it, how do you know? Is it just literally month-by-month data that keeps on going down, or is there a measure that you look for to preempt?
Well, there are measures that can preempt. So inflation's more than one thing, and there's like a leading edge of inflation, if you like, that's already falling. So some commodity prices, if you look at surveys of things like supply chains, they're very much opening up. So there is lots of slack in supply chains now, so less focus on China and what it might do to supply chains. But core inflation measures like wage inflation, service inflation, shelter, they can take a year to peak after the headline measures peak. So we're at that early edge now where it feels like the markets will be talking about falling inflation next year and headline measures should be falling. But that doesn't mean to say the Fed will immediately cut rates.
Can we avoid a recession in the U.S. and overall, where's the leverage? Is this the biggest question that you need to try and answer as interest rates go up, and they're going up quite rapidly? Are there parts of the markets that you worry about funding?
Yes. So can you avoid a recession in the U.S.? Possibly. So I've heard the argument that inflation will fall so dramatically that real incomes will expand and there'll be no need for a recession. I'm really skeptical about it because if you look at things like housing, so you go back to the interest rate sensitive bits of the economy, housing looks like it did in the mid-2000s. It's looking horrible. This is a Fed-induced recession. So I think it's very hard to avoid the recession.
So where do you put your money?
Well, at the moment, we're beginning to like government bonds. Beginning of last year, we were maximum underweight. This year, I should say, maximum underweight government bonds. But the way we look at next year, it should be a slowdown, but this time with headline inflation measures dropping. And I think the long end of bond markets is starting to look interesting.
Okay, interesting. Trevor, thanks so much. Trevor Greetham, head of multi-asset at Royal London Asset Management, stays with us. We'll talk a little bit more about bonds, but we'll also talk about some of the corporates out there. Coming up, Disney soars as a media giant, brings back former leader Bob Iger as chief executive. Well, we'll have all of the details next, and this is Bloomberg.
is an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority.
Economic, finance, politics. This is Bloomberg Surveillance, early edition of Francie Lacqua here in London. Now, Disney has soared in pre-market trade after welcoming back the former chief executive Bob Iger to his old job, effective immediately. Well, Iger stepped down as chief executive in 2020 after leading the company through a period of enormous growth over 15 years. Well, he remained on the board of director for another year. Joining us now is Alex Webb of Bloomberg Quick Take, and Trevor Greetham, head of multi-assets at Royal London Asset Management, is still with us. Trevor, we'll talk about corporates and some of the changes in general, what kind of leader you're looking for in companies. But this is incredible. I mean, this is an incredible story. So Bob Iger's back. The Magic Kingdom hasn't been so magic in terms of returns in the last couple of years.
No, and astonishingly, Bob Chapek was awarded a new contract just over the summer. So the change here has been rapid. The thing that had happened with Disney is that activist investors had looked at the share price of Netflix, and particularly the price-to-earnings ratio. It was trading something like 50 times forward earnings. Disney was trading around the 20s, and they said, well, we'll have a piece of that, thank you very much. You should be more like Netflix. Therefore, Disney pivoted, investing significantly in the streaming platform, Disney+. It then got pretty close to Netflix as a price-to-forward earnings ratio, I should say. Then, of course, we saw the fallout of the pandemic conditions easing, and Netflix, its user numbers stagnated, its share price fell, Disney followed it.
I mean, I just find it incredible. So the share price in Germany at the moment in pre-market trading today is up 10%. I mean, they still have an activist investor on their back. Was it because the chief executive was shockingly bad, or is it really because Bob Iger can turn this around once again?
A lot of the commentary we've seen is that actually the messaging is kind of what's important. That it's not necessarily there will be significantly changes in the strategy. The one thing that Bob Chapek had not been terribly good at communicating was actually how this capital that is being spent right now on content for the streaming platform might ultimately yield dividends. And you pair that with the impact internally on the culture, where Bob Chapek had made some decisions that weren't terribly popular, trying to move staff to Florida, political things that he maybe hadn't been as outspoken on as Iger had, tentative support seemingly for Republicans, as has been reported, because there was an expectation that they would do very well at the midterms. That has maybe backfired, as we can see. So there's lots of moving pieces here. Ultimately, Bob Iger, steady pair of hands. It's only a 2-year contract. We'll have to see who else comes in.
So, Trevor, I know, I mean, you don't want to talk specifically about Disney, but does this show the difficulty of media companies? I mean, these are, again, they have parks, they have now to make TV shows catering for a streaming service, which is what they bet on, or is this just stamp kind of bad chief executive being replaced?
Well, I think stepping back a little bit, there's a general message in the markets for growth companies, so be they media, be they technology, where rising bond yields has seen multiples collapse in the stock market. And as a macro person looking at that, it's been very interesting to see how people immediately point the finger and say every chief executive of a growth company must be terrible. Their most recent decision must have caused the stock price to drop in 2022. That's not the message the markets are giving at all, actually. They're just derating the growth stocks because interest rates have changed. That said, in this environment, as a CEO, you do need to make sure you're not over-investing in things which will be very economically sensitive in the recession. So the message to sort of scale back a little bit, which some of these companies have taken, isn't because their last move was stupid. It's because the cost of money has changed.
Yeah, and one of the things they say, I mean, for Iger specifically, is that he is, for example, very popular with the rank-and-file workers. How do you choose what industries you want to be invested in right now?
Well, I think it's a question as a top-down investor of that interest rate sensitivity, where that's starting to become more interesting, and earnings resilience. And so if you can imagine that we're getting more interested in government bonds, that means there'll be sort of stable growth companies that could actually do very well, and consumer staples, or some of the technology and media companies with more reliable earnings.
I always enjoy your Twitter feed, and sometimes Trevor also, gives it back to Elon Musk, or certainly you weigh in on some of the big.
I'm not the only one.
No, you're not the only one. I mean, it's like a national obsession. Like, why are we so obsessed with what's happening to Twitter?
I mean, it makes for great copy. A lot of it, it's so many moving parts. There's great, huge personalities, not least Elon, but some of the other people involved. It is a fascinating story. The thing I've long been trying to point out, Twitter is not a big company in the grand scheme of things. It has an outsized influence in terms of politics, particularly given who its audience largely is. But the data point I often point to, Twitter's revenue is less than BT's profit. It is not a large company. It is not a big tech company, but it is very influential in Silicon Valley.
Yeah, and I know you also cover FTX, and this, 50 creditors are owed something like $3 billion. What does that tell you about the space?
I'm one of these sort of skeptics that sort of back in 2017, I was sort of saying, I was being asked a lot, as an asset allocator, why don't you have an allocation to crypto generally? And my view was there's no long-term track record, you don't understand its economic sensitivity, and it's very prone to fraud. And I think that's what we're starting to see here. So I think it does cast a bit of a pall over the space.
All right, thank you both for joining us. Alex Webb, there of Bloomberg Quick Take, and Trevor Greetham. Also give him a follow on Twitter, head of multi-assets at Royal London Asset Management. Coming up, we're live at the CBI conference, where the Prime Minister is set to address the UK's biggest business group. That's coming up next, and this is Bloomberg.
There's more activity in the fusion world than ever, and not just in government research labs. There's also an emerging private fusion industry that's attracted billions of dollars in capital in recent years.
Governments and private investors alike realise that we've got to find a solution that's going to allow us to get to net zero targets.
This is one of the hardest but most rewarding problems that humanity could work on. Ultimately, we all want the same thing. We want someone to put electricity on the grid from a fusion power station as quickly as possible.
Frankly, the scale of the challenge, 3,000 gigawatts of fossil fuel to replace, there's not many things that can do that. In fact, there may only be fusion that can really do that.
And while many in the scientific community predict fusion power will take decades, some in the private fusion space believe we'll get there in just a few years, as soon as the 2030s.
Power, policy, politics. From the White House House to the Hill, Bloomberg covers the leaders in legislation.
That was really a tectonic shift for this White House.
The theory of this bill, as I understand it, is there'll be a multiplier effect.
How did Democrats mobilize specifically younger voters?
Bringing you the political news you need to know.
The president has made it very clear that this is a significant focus.
For the intersection of Wall Street and Washington, nobody covers politics like Bloomberg.
You will shed light on dark matter. You will make aging optional. Because when you subscribe to Bloomberg, you won't just get news. You will get insight into limitless possibilities. Before you change the world, Bloomberg.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg Business Flash. Here's Alice Atkins. Hi, Alice.
Hi, Francine. New court papers show Sam Bankman-Fried's bankrupt crypto empire owes its 50 biggest unsecured creditors a total of $3.1 billion. According to the redacted list, entities linked to FTX owe their single biggest creditor more than $220 million. Investors continue to pull funds from digital asset exchanges despite efforts to reassure markets about their stability. Walt Disney is bringing back former CEO Bob Iger to run the company. The 71-year-old spent more than 4 decades at Disney, including 15 years as chief executive. The company says he's agreed to serve for 2 years, succeeding Bob Chapek, who is leaving immediately. Disney shares are heading towards their worst annual loss since at least the 1970s. Sweden's home prices decline accelerated in October, with values now 14% down from their peak earlier this year, according to data from ValueGuard. It's the most severe housing slump in 3 decades, fueled by soaring inflation and central bank moves to curb price increases. The IMF says the rise of trade barriers against China and other countries over the past year could cost the global economy $1.4 trillion. Fund manager director Kristalina Georgieva says the potential loss for Asia could be more than 3% of GDP because the region is more integrated into the global value chain. The COP talks in Egypt have ended with an agreement to help developing nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. And the UK government says it isn't seeking a new Swiss-style relationship with the EU. The pushback comes after a Sunday Times report that Prime Minister Rishi Sunak's administration is exploring closer economic ties with its European neighbours. Switzerland is a member of the European Free Trade Association and participates in the single market for most goods. The UN's atomic agency says powerful blasts have shaken the area around Ukraine's Zaporizhzhia nuclear power plant. The IAEA says some buildings and systems were damaged, but none critically. Ukraine's nuclear regulator says Russian forces struck the facility. Moscow blames Ukraine for the shelling. That's your Bloomberg Business Flash. Francine?
Alice. Thank you so much, Alice Atkins. In London, now the former Treasury Secretary Lawrence Summers has a warning for U.S. policymakers. Focus on building your own economic strengths in the contest with China rather than attacking them. Here's more from his conversation with Bloomberg TV.
I think it's a mistake to be slavish about Taylor rules. The market thinks the number's going to be about 5. I look at things and my sense is there's more room for that to be too low than there is for that to be too high. But it's pretty clear that we've had the big moves on this cycle, and now we're going to be finishing that process off. But I think that the Fed has this in the right place when it says that they're going to move up somewhat more, and they're going to take stock of the situation and see what the inflation data is saying and seeing what the inflation forecasts are saying when we get to the spring of next spring of next year. I have to say that if they hadn't made as many mistakes as they did of excessive optimism about inflation, they'd probably have a little more room than they do to rely on forecasts that hadn't yet proved out that inflation was going to come down.
Larry, you and I talk a lot about monetary policy, even fiscal stimulus and things, but geopolitics have also factored increasingly in some of the issues having to do with the economy. This week we had what is potentially, we don't know if it is, an important development in the meeting of President Xi of China and President Biden. What do you make of those discussions and even ongoing discussions? Because now we have the USTR, Madam Tai, actually meeting with her counterpart. What do you make of the situation with China right now in the United States?
Look, as Churchill famously said, jaw is a lot better than bang bang. And so the fact that they had a meaningful conversation that lasted more than 3 hours, the fact that they both came out of the conversation with a sense that there had been satisfying dialogue, the sense that there are some follow-on steps, I think that's all to the good. What it's really going to mean, what really is going to happen, is there going to be constructive movement out of those dialogues? I think that's something we're going to have to wait and see. We in the United States probably need to be careful about our evangelizing influence. I don't think it's really for us to tell China how they should organize their entire society. I think it's for us to stand up for some of our fundamental interests in security and fair economic competition, but to leave it at that point. I think we're going to need to be very careful with respect to our diplomacy.
Well, that was a former U.S. Treasury Secretary Larry Summers speaking on the U.S. and China to Bloomberg TV. Now, coming up, we'll get back to the markets with Kim Fournet. He's Saxo Bank Chief Executive Officer and Founder. In the meantime, a lot going on in the markets. The focus firmly on what's happening in China, but also we're seeing some euro-dollar moves, for example. Now, stocks are dropping. They started by dropping in Asia. They're still dropping in Europe. There's concern that China may actually tighten its COVID curves. This is after a series of reported deaths. The other story we're watching out for is Disney. Now, pre-markets, it's now open and it gained some 10% after a replacement of the chief executive. They brought Bob Iger back. The dollar also climbing against G10 counterparts and emerging market currencies. Treasury is giving back earlier gains. Oil down on concern of a weakening demand outlook from China. We'll have plenty more on the markets. This is Bloomberg.
What do you think of when you think of a battery? For most, it's what we use to power devices for both work and play, and maybe even your car. Over the past few decades, they've gotten way more powerful, long-lasting, and affordable. But all of this is just a prologue to what the next batteries are going to do.
As we drive to an increasingly renewable power-driven grid, we also need to be able to store energy and release it later to cover those periods of weather intermittencies that are driving this new grid that we're in. It's a multi-trillion-dollar opportunity, and it's imperative that we figure out the solution here.
How we store energy on a massive scale is in many ways the central challenge of the fight to stop climate change.
of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority.
COVID-0 concerns. Stocks drop, treasuries and the dollar gain as Beijing tightens curbs amid a resurgence of the virus, including the first fatalities since May. Seeking the old magic, Bob Iger makes a surprise return as Disney chief executive amid a string of disappointing results and a slumping share price. And historic agreement, negotiators at COP27 reach an 11th-hour deal for a fund that compensates developing nations for climate devastation but falls short on fossil fuels. We're live in Sharm el-Sheikh. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get straight to the Bloomberg First Word News with Alice Atkins. Hi, Alice.
Hi, Francine. Malaysia's political leaders now have until 2 p.m. Tuesday local time to decide on a prime minister. The king has extended the deadline by 24 hours after Saturday's vote resulted in the country's first ever hung parliament. Opposition leader Anwar Ibrahim says he has the numbers to form a government despite falling short of a simple majority. The COP talks in Egypt have ended with an agreement to help developing nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. The UK government says it isn't seeking a new Swiss-style relationship with the EU. The pushback comes after a Sunday Times report that Prime Minister Rishi Sunak's administration is exploring closer economic ties with its European neighbours. Switzerland is a member of the European Free Trade Association and participates in the single market for most goods. The UN's Atomic Agency says powerful blasts have shaken the area around Ukraine's Zaporizhzhia nuclear power plant. The IAEA says some buildings and systems were damaged, but none critically. Ukraine's nuclear regulator says Russian forces struck the facility. Moscow blames Ukraine for the shelling. New court papers show Sam Bankman-Fried's bankrupt crypto empire owes its 50 biggest unsecured creditors a total of $3.1 billion. According to the redacted list, entities linked to FTX owe their single biggest creditor more than $220 million. Investors continue to pull funds from digital asset exchanges despite efforts to reassure markets about their stability. Walt Disney is bringing back former CEO Bob Iger to run the company. The 71-year-old spent more than 4 decades at Disney, including 15 years as chief executive. The company says he's agreed to serve for 2 years, succeeding Bob Chapek, who is leaving immediately. Disney shares are heading towards their worst annual loss since at least the 1970s. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg. Francine?
Alice, thanks so much. Alice Atkins here in London. Now, negotiators at the UN COP27 Climate Summit have reached a historic last-minute deal on payments for climate damages. Let's get out to Bloomberg's Jennifer Zabashazra, who's in Sharm el-Sheikh. Jen, finally, there's something new that's been agreed, but it's not the all-encompassing deal that many were hoping for.
It's not, Fran, and you know that because you were here for the first week. But, you know, developing nations that we've been speaking to were noting that it took 30 years to even get loss and damage on the agenda. So the fact that the summit is ending with a fund in and of itself is seen as a positive. We heard that from Pakistan's climate chief, who noted that this is the first positive milestone, but now the work will really begin on how to actually structure this. And that's going to be key for the transitional committee that is going to be tasked with making, deciding what this is going to look like heading into COP28. But really ending this COP, there's a lot of disappointment from a number of people who say that this COP really failed to deliver a stronger stance on mitigation. We know that there was a lot of calls from India, from the US, from the EU to potentially include the language of phasing out all fossil fuels. But instead, the final text includes just phasing down unabated coal, which is the same text that we saw from last year in Glasgow. And we heard Frans Timmermans specifically noting that it's not enough of a step forward for our planet. So there's really a lot of different opinions out there right now. We did see a lot of progress on climate finance fronts for countries like Vietnam and Indonesia, but still, Fran, not exactly the outcome that I think everyone was hoping for ending this COP.
Jen, thank you so much. Jennifer Zabuzaja there for us in Sharm el-Sheikh at COP27. Now, stocks lower today amid concern that China may tighten COVID curbs after a string of reported deaths. Investors are seeking shelter in the haven assets of treasuries and the dollar. And we're joined by Saxo Bank's chief executive and founder. He's Kim Fournet for an exclusive conversation. Kim, as always, thank you so much for giving us a little bit of your time. You make us smarter on some of the macro trends and some of the opportunities out there for the market participants and the bank. What do you see unfolding over the next 6 months? How ugly will the markets get?
Well, clearly we're still in quite a bit of a turmoil, and I think many different things are hitting us: climate crisis, wars, inflation, rising interest rates, soft stock markets, and I think it'd be unlikely, also with everything we see in the crypto market and so forth, that there would not be some fallout from this, because clearly debt levels in the world are bigger than ever before. Interest rates are going up, so servicing the debt should be more difficult. Clearly, we have not seen any specific signs yet, at least not the grave ones. But I would anticipate that we're not kind of done with this. There will be delayed effects from everything we've seen now. And obviously, there's still a lot of money, but I think it'll be more difficult in this environment not to see things further accelerating on the downside.
So, Kim, what are you most worried about? I know, of course, it's inflation, it's the terminal rate, but do you worry about leverage, that parts of the markets are fine when interest rates are at 1%, even 2%, and it gets much trickier at 5%, 6%?
I'm sorry, could you say that again? I didn't hear. There was a problem here. I'm sorry about that.
Yeah, Kim, I was going to ask you whether you saw a lot of concerns on leverage, whether parts of the markets are over-leveraged, so that it's you know, there could be a liquidity squeeze or a crunch similar to 2008 if parts of the markets go under as interest rates increase rapidly.
Sure. Well, I think exactly that leverage is there due to much debt, because debt really is leverage. And as debt levels have never been bigger, of course, this is a big problem when interest rates are going up. So I do think we will see some fallout from that. And I think it will obviously particularly hit the ones who do not have the proper solvency or capital, or do not have appropriate cash flow. So I would think of it unlikely that we do not see some fallout from that leverage, and we'll see potentially something that could even end up in certain areas to be a credit crunch or something.
The FTX fallout is pretty incredible. I know Saxo offers some crypto trading opportunities. How do you look at this pretty incredible story over the last 3 weeks?
Well, I think it's an incredibly and terrible story. Unfortunately, another one in quite a long line of unfortunate events. Again, the way we offer crypto trading in Saxo is very different. It's really linked up against the main currencies, US dollar, yen, and euro. So we actually having a compliant product. We don't have any cold or hot wallets or anything. So, and we offer very tight spreads, but also that means that you have best execution. You have basically a compliant product. And I think what's the problem within the crypto industry on a larger scale is the fact that you know, all the consumer protection, all the best execution, all the prospectus, knowing what you're buying and so forth, it's just not there, and it's not being regulated. And we have seen not one but many fallouts, FTX just being a really big one here. And it's kind of obvious, we've talked about this for a long time, but it obviously needs regulation, and we need to make sure that when people are taking an onboarding client and client funds, well, they need to also be responsible and make sure they keep the proper capital and liquidity levels.
But so, Kim, what does it mean specifically for Saxo Bank offers? Are you cooling off crypto until there's more regulation? Does it impact the services that you will bring forward?
Actually, the way we do it is you know, we are a fully licensed bank, and we do deliver a compliant product. So we call it crypto FX. So you can trade Bitcoin, Litecoin, Ethereum against Euro, Yen, and US dollars. And that business has not had any issues. We do not have any cold or hot wallets, and we don't offer that for clients. So you can say that we trade cryptos in a compliant and regulated manner, and we also offer the exchange traded products on this. So we don't really we've not experienced any fallout from this, other than what everyone can see, which is obviously very soft markets, and again an unfortunate situation for the whole marketplace, where global valuations have gone from 3 trillion to, I don't know what it is now, maybe 600-700 billion. So there's still a lot of money in there, but they're flowing out quickly, and we can see a lot of people have lost many you know, money, and that's a sad thing.
Kim, you know, first of all, congratulations on Saxo Bank on its 30th anniversary. What happens next for Saxo Bank, and how you want to grow? Will you IPO? Will you be part of a SPAC?
Well, we are looking. I think my mic went there. We are looking at doing a listing, and we have announced our intent to list. So we are working hard on that as we speak. But right now, it's really about running the business and trying to have a good situation there, where, you know, we completed the Bing Bank migration a few weeks ago, and this has been a very, very big effort for us. So we're really focused on just working with the clients. We have a lot of additional products, platforms, services that we are rolling out across the board. So we are working very closely with our clients and our partners, and obviously navigating difficult times. But I think Saxo is in a very good shape, and eventually we would like to be a listed company, and that is what we're pursuing full speed ahead. Even though that the external circumstances are obviously not so optimal for that, but the internal ones, Saxo Bank is having a good business, and I feel very good about the future after 30 years.
So Kim, yeah, and again, congratulations. How fast do you think you can list, and where would you list, and how much would the bank be valued at?
Well, we are working on this as we speak, and there's not so much information I can provide on this at this stage. It's not going to be this year, so hopefully beginning of next year we'll come out with some more firm information on what all of that looks. We are aiming for Amsterdam Euronext, so at least that part of it is pretty clear. But again, it's not happened until it happened. Many things can. I mean, we live in an unpredictable world. The good thing is that Saxo is a profitable business. We have very, very good capital levels, so we are very stable. We don't need to do anything, but we do believe that it will be a good idea to come out with a smaller slice of the business and create liquidity and a structure for future shareholders. And also we did buy Bing Bank some years ago, which was successfully integrated, and to get acquisition currency to maybe do something like that again would be helpful for us as well.
Kim, thank you so much, as ever, for your time and wisdom, and also unflappable. Kim Forney, readjusting his mic, the chief executive there and founder of Saxo Bank. Coming up, COP27, over and out. We'll wrap up the finale of the climate conference. That's coming up next. This is Bloomberg.
A digital-first approach to the future of work is where the industry and all companies will be heading.
Could the future of work not be at home or in the office, but in the metaverse instead?
There's that word, metaverse.
Doing well. How are you doing?
When I think about the metaverse, I think about immersive experiences that have a sense of active presence.
Wow, look at this. This is me. The metaverse is projected to become over $1 trillion market by the end of this decade. And whether you know it or not, you'll probably be working there in the future.
We're moving into a world where we're going to be interacting with computers with our bodies.
This is definitely trippy.
I think the adoption curve is going to be slow.
It's
doing
weird.
Like a weird floaty thing right now.
Oh, look at you. You have no legs.
It's kind of a fun world, and we're just at the very beginning of a very long journey.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Aqua here in London. Now, the 2022 World Cup has kicked off in Qatar. A lavish opening ceremony was followed by the opening match between the hosts and Ecuador. It's a culmination of a 12-year build-up that's been marred by controversy over the initial bid, human rights concerns, and the environmental impact. Well, Bloomberg's Simone Foxman was watching from the stands. Simone, first of all, what did the opening ceremony and match say about Qatar's ability to manage this massive event?
Well, as a test of Qatar's ability to manage a major sporting event, I think all went pretty well. Yes, there were quibbles. There was a lot of traffic getting to the event. Some of the food options ran out. But for the most part, there was an exciting opening ceremony. Match on the field, a little less exciting. Qatar clearly outplayed really from the start. 2-0 Ecuador winning that match. And that likely cuts off Qatar's chances for advancing out of the group stage in the tournament. But really clear to me was who was in attendance on a geopolitical front. There were lots of regional leaders here. We saw a picture published by the Turkish state-run news agency of President Erdogan shaking hands with President Abdel Fattah al-Sisi of Egypt for the first time. There are tensions, massive tensions between those two countries. And then we also saw Saudi Crown Prince Mohammed bin Salman. He was just 2 seats away from the Qatari ruler, and he was in close discussions with FIFA President Gianni Infantino. Wonder what they were talking about, the potential for a Saudi World Cup, maybe.
I mean, maybe certainly that would cause more controversy. How are corporate sponsors responding to an event that's garnered so much public criticism, Simone?
Yeah, if this one's been controversial, imagine what would happen if there was a World Cup in Saudi. But, you know, look, I reached out to 76 sponsors, both of national teams based in the US, Canada, and Europe, and also to FIFA sponsors based in those same places, and places where the criticism of human rights abuses in Qatar has been widespread. And I less asked them about, you know, the rights issues themselves than I did, how are you responding to this? Are you changing your global marketing strategy? The vast majority said no, or just plain didn't respond to me. I found just 13 teams said they were changing their strategy in order to account for human rights, and only three of those brands actually had ties in some way, business ties to Qatar. So as much as corporate CEOs go out there and they talk about ESG and social impact, you know, what I found was ad dollars, 5 billion viewers potentially watching the World Cup. There's not much change in the way these companies say they're going about things.
Simone, thanks so much. Simone Foxman there joining us from Doha. Now, coming up, COP27 over and out. We'll wrap up the finale of the climate conference. That's coming up next, and this is Bloomberg.
There's an epic saying in Italy when it comes to family generations that the first generation creates, the second generation expands, and the third generation destroys. And that's almost what happened in the Gucci story.
So hate and love together.
Now I would have a much more experience about those who says I love you and then betray you.
The Gucci family was the strength, but also the weakness of the label.
The situation became dire with Gucci's finances. They were not able to pay salaries. They were not able to pay suppliers. Gucci's really teetering on the brink at this stage.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues.
We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Count Under the Close. Welcome to Bloomberg Crypto.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, the COP talks in Egypt have ended with an agreement to help developed nations face the devastation of climate change. Although the deal for a loss and damage fund paid for by rich countries is seen as a breakthrough, negotiators failed to agree further cuts in CO2 emissions. Now, we're joined by Nazmira Mullah, Chief Sustainability Officer at 91. Nazmira, thank you so much for joining us. First of all, we have heard quite a lot about GFANZ and the fact that maybe some money behind the transition are, if not getting cold feet, wondering what the parameters of this is. Are you a bit disappointed that the move to sustainability or to greener technology and transition could have more teeth?
I think it was always going to be a long journey. It was never going to be as clear as we all commit in the same year and everything moves in a straight linear line. So I think there are some disappointments from this COP, but there are also some major wins. As you noted, the Loss and Damage Fund, the announcement on that I think is a big positive. I think also the announcements around plans to reform the global financial system, particularly around the MDBs to provide more climate financing, is also a big positive. There were some areas which were not as positive, the fact that there's not as much progress around mitigation commitments, the fact that there's no agreement on peaking emissions by 2025, but I think what gives me the most hope at this point is this continued push to just build out the new technologies, to get the mitigation technologies onto the ground.
Nazmira, Republicans have also signaled that they'll use their very slim majority in the House to make it maybe more difficult or make life harder for companies embracing ESG. Is this a real threat?
I think that we need to differentiate between the concerns around ESG and potentially concerns around moral values being imposed on portfolios and the idea of investing in the new green technology. I think a lot of what we're seeing from the Republicans is concern around phasing out of fossil fuels, which is a big part of what needs to be done. But the part they seem to be very happy to go along with is just building the new green technology. So the biggest builder of renewable energy in the United States is Texas. If you look at the Inflation Reduction Act, there may not have been a whole lot of support from the Republican Party, but there are many Republican states that are going to take massive advantage of the benefits of that act.
But do you see any of this actually affecting the flow of capital potentially away from some of the ESG goals?
I think that's something that we'll have to monitor as it goes along. I mean, I think as far as COP goes, as far as COP27, I think the focus on mitigation is being clear. I mean, we saw that with the Indonesia transaction. If you look at South Africa last year, it was much more combination of the shutdown of old coal-fired power stations and building the new energy. Indonesia is much more around how quickly they can build new renewable energy. And I think that's where the focus is increasingly shifting at this point.
Nazmira, overall, what kind of adjustments are you making to your allocations to reflect some of the developments at COP27? I know they were slim, but there's a couple of things that happened and were signed off on.
I think one of the things we saw at COP is this continued rhetoric around the need to fund the emerging market transition. What worries me a little bit is you haven't seen capital flow in anywhere near the quantum needed for that. So we know that portfolio flows into emerging markets have been challenged because of the macro, but the blended finance flows are also down. So the latest report from Convergence shows blended finance flows into emerging markets, particularly around climate, but in general, are down if you take the last 3 years compared to the previous 3 years. And that's exactly the opposite of what we need. So now we talk about these JETPs, and yes, they're important and they're catalytic, but we aren't seeing substantial amounts of really concessional capital coming to bear as yet. I'm hopeful we may see more, but it hasn't happened as yet. So what I'm doing is we are looking at allocating towards the companies and countries that are doing the most to transition, because a large part of that transition can be done by the commercial private sector, and that's what we need to support.
Great. Thank you so much, Nazmira Mullah, their Chief Sustainability Officer at 91. Now, Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller and Kay Lyons in New York. Anna Edwards is here in London. And of course, a lot of the show will be focused on the UK. A Brexit debate does seem to be returning at the forefront of UK politics. So Lizzie Burden is also at the CBI conference in Birmingham. And then the stocks still dropping on a lot of concerns surrounding China. Dollar is definitely seeing a bid. 1,291. We chose the Bloomberg US Dollar Index. And then Disney, look at that, gaining 8% after they went and got back the former chief executive. This is Bloomberg.
These floating flowers are made of 92,000 solar panels. Laid on the surface of a reservoir, they can generate 41 megawatts, which is enough to power 20,000 homes. It's one of the biggest floating solar plants in the world. Floating solar arrays have been gaining traction in Asia, including countries like Singapore and Thailand. Floating projects typically benefit from an easier connection to the power grid. They can also restrict algae blooms while keeping the solar panels cool. This one in particular has helped the local economy. When the power plant was first proposed, residents were given the chance to invest. Some locals were also offered jobs during construction. In fact, it was the community that requested the panels to be shaped as flowers to look more appealing. South Korea still relies heavily on imported fossil fuels, but will need to change that to reach its goal of becoming carbon neutral by 2050. Solar plants like this one may help the country reach its net zero goals.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Rally could continue. I do think it is a bear market rally. I mean, you know, it could go to the end of the year.
I think we have to be a bit careful.
I think we're still going to be facing an awful lot of volatility in 2023.
Really what we're dealing here is potentially with an earnings decline that is not yet priced into the market for 2023.
Given the structure of the S&P, there are huge opportunities underneath the surface.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong. Our top stories today. Disney's surprise. Bob Iger is back as CEO after a string of disappointing results and a slumping share price. Far from zero, China's first COVID-related deaths in almost 6 months has sparked concern that Beijing could see a return to heightened restrictions. And $3.1 billion, that's how much FTX owes its 50 biggest unsecured creditors. We've got the latest on the ongoing crypto crisis. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Good morning to you, Kaylee, and to Matt. And Kaylee, it seems another week, and we've turned a bit of a corner on the China story, now worrying about the reaction function we're going to see from Chinese authorities, whether it'll be the old COVID zero playbook as cases rise.
Yeah, Anna, it's definitely an abrupt U-turn on what had been optimism about the reopening of the Chinese economy. We'd seen a massive rally in Chinese-sensitive stocks as a result, but now concern back to the forefront that tighter curbs could go into place after those reported deaths over the weekend. So that dragged heavily on risk sentiment in Asia overnight. The Hang Seng China Enterprise Index down about 2%, and the losses were even greater for technology stocks in particular, which had seen really big gains over the last several weeks. The Hang Seng Tech Index down about 3%. And of course, it's filtering through to other asset classes as well. In foreign exchange, the Chinese yuan weaker against the US dollar by about 7/10 of 1%. 717 rather is where we trade. And of course, there is a read through to the commodity complex, given so many of these commodities are very sensitive to the China demand story. Iron ore specifically, with those futures down about 3.5% overnight to around $95 a ton, Matt.
All right, and we're watching, of course, the yen weakening against the dollar as well right now. Dollar strengthening against a number of other currencies. Here you can see in the second row, the Bloomberg U.S. dollar index now up to 1291, back up to 1291, so climbing ever higher on concerns about the COVID crackdown in China, the about face that we saw there, and we're going to talk about that in a little bit. S&P futures down on that as well right now, about 0.5%. We were up about 0.5% on the cash trade of the S&P on Friday to about 39.65. We're losing a little bit of that steam right now. NYMEX crude is also coming down. If there is a continued slowdown in China, we don't have that reversal that may have been a little bit of a lift for prices, and so we're back down below $80 a share at 79.71 on West Texas Intermediate. Finally, Bitcoin right now trading just above $16,000, $16,093. It had fallen below that, and I'm sure that's going to affect a lot of companies like Riot Blockchain and Coinbase in today's trade, but we're definitely watching this $16,000 level, which had been until now a support. Anna, what do you see in Europe?
Yeah, well, here in Europe then, Matt, we've seen 4 weeks of decent gains across European equity markets. Have we drawn a line under that, though? Are we now in a consolidation phase? Are we done with the rally into the year end? Still in November, of course, but this is what we've got with European stocks right now. Just down by 0.1% on the FTSE 100. The CAC 40 a bit more than that. The DAX down around 0.5%. We are off earlier lows of the session, so we were down weaker than this a little bit earlier on in the day. Barclays talking about 2023 being a better year for European stocks, saying by the end of the year, at least, we will have worked through some of the headwinds, but that seems a very long way off right now, doesn't it? This is what we're dealing with here in Europe right now. And the FX moves have been big overnight, and Kaylee and Matt have talked about some of those. So let's get to what that's doing to European assets. Maybe the pain of that strength of the dollar has been one that US corporates have been feeling. Some European companies feeling it as well, of course. And we've got the pound here down by 0.7% against the US dollar as we see a return to that strong dollar vibe. The euro also down by 0.9%. So this really is a strong dollar story, not weakness in these particular currencies today. And the strong dollar being driven, of course, by what Kaylee was talking about over in China and the fight against COVID that continues there. Brent crude down by 0.6%. Matt had the WTI price. We're down well below $90 a barrel. Had we seen support coming through from an expectation of a pivot in the way that China deals with COVID, we've seen that Goldman Sachs has reduced its call on where energy goes from here and bringing down its oil price call by around $10. Julius Baer Group up by 0.6%, so outperforming the broader space. We heard from them in terms of numbers, reporting to the markets today. The money manager based in Switzerland, in line with expectations really as far as its targets are concerned, not changing those, but saying it sees better things in terms of the net new money or the new money coming into the business, Matt.
All right, very interesting stuff. We're going to continue paying very close attention to that as we do all of the wealth management stories, of course, around the world. A lot of those wealth managers own Disney and had been disappointed with the CEO, Bob Chapek. Well, now Disney is bringing back its former CEO, Bob Iger, to run the company, which is a surprise move by the board after a string of disappointing results by Chapek. Iger stepped down as chief executive in 2020 after leading the company through a period of enormous growth over 15 years. Alex Webb of Bloomberg Quick Take joins us now for more. So this was unexpected, and we got a new activist shareholder, or an activist shareholder building up a bigger stake as well, right?
Yeah, the thing we'd seen over the course of the pandemic was that early on, we had activists come in and say that Disney needs to be more like Netflix, i.e. become a growth stock, cut the dividend, invest the capital in content for the streaming service Disney+. And at that stage, Disney had been trading around the 20-something times forward earnings. Netflix was 50-plus times forward earnings. Disney subsequently overtook Netflix on that basis. But what we've seen since then is that growth stocks have been punished as interest rates have increased. So the question that Iger now faces is will he do better to take more money away from Disney Plus and increase the dividend? Or should he still try to position Disney as a growth stock at a time when it isn't particularly rosy for those kind of equities?
Yeah, good morning to you, Alex. Yeah, as money becomes more expensive to do new things and to invest in new stuff and in growth. So what can Disney change then from here?
Well, it can take money away from Disney Plus and decide to increase the dividend. There are some internal cultural things. There's a lot of basically communication with capital markets that perhaps needs to improve. What is the purpose of the spending? What is it going to yield over what sort of time frame? Now, at this stage, people are not looking as much for stocks that have longer returns. They want stuff that's more immediate, and so that might be the first thing Iger needs to look at.
All right, Disney shares up 8.5% right now in pre-market trading. Bloomberg Quick Takes Alex Webb, thank you so much. Let's turn back now to the China story. The country's first COVID-related deaths in almost 6 months are sparking concern that Beijing could see a return of tighter curbs. Enda Curran, our chief Asia economics correspondent, joins us now from Hong Kong with more. So Enda, how realistic is it that we see a reopening of this economy if deaths might be on the rise?
Well, it's going to be a big test of this recent COVID zero pivot, Danny. As you mentioned, cases are surging now. We've had those first fatalities in 6 months. We're heading into winter time. Officials are obviously at a very delicate stage because on the one hand, of course, we had the signaling from the top of government that there could be some more targeted kind of restrictions to slow down the pace of COVID spreading rather than the blanket lockdowns we've seen in the past, less mass testing, less kind of lockdowns. But we have seen now already some reversal of some of that. Sitting near Beijing, for example, our colleagues reporting quite widespread restrictions in place there, even though they had been easing as a city themselves in recent weeks. So it is a big test. Remember, there's a lot on the line politically. China has made a big deal out of their overall fatality rate being so low compared to other parts of the world, especially the US. But of course, we now know there's so much pressure on the economy, both from the real estate and the COVID zero lockdowns, that there will be a lot of pressure on the government in terms of how we do handle this. And I think we're heading into how the government handles it, and we are obviously heading into a very critical period over the coming weeks as we go deeper into winter.
Yes, and as far as the market and the economic fallout from this is concerned, of course, last couple of weeks have been dominated by markets rethinking China and thinking there was going to be a pivot away from the really harsh COVID-0 policies towards something looser, that would pay dividends for the Chinese economy. Some of that prize just gets pushed into the future, I suppose.
Well, it does, but the state press this morning, in terms of conflicting signals, Anna, the state press this morning were saying, look, let's not go back to those blanket kind of lockdowns or restrictions that China has become known for earlier in the pandemic. Try to do something more targeted, but obviously officials on the ground must be wondering, how can they figure that out? How can they control cases without reverting to these big broad-based lockdowns? And this is where the market story comes in. There has been optimism that when China does pivot away from COVID-0, the economy recovers and you're back to investing in the China story. But it must be said that right now, China remains to have in place some of the world's most strictest measures to control COVID, and it does feel like we remain some time away from a full and complete exit from the COVID-0 strategy.
Enda, thanks very much. Bloomberg's Enda Curran coming to us from Hong Kong. Let's get now the latest on the crypto situation. New court papers show Sam Bankman-Fried's bankrupt empire owes its 50 biggest unsecured creditors, customers that is, a total of $3.1 billion. Anna Herrera, Bloomberg senior crypto editor, joins us for more. So Anna, two of those customers had more than $200 million on FTX's books.
Yeah, so we're trying, obviously, everyone, I guess, is trying to figure out who these creditors might be, because there might be ripple effects, right? Like, they might have the creditors, too. So, you know, this is clearly a sign that there might be some more contagion coming.
There might be some more contagion coming. What do you make of the fact that Bitcoin's dropped below 16,000? I mean, on one level, there's been a slow and steady drop. On another, it seems fairly controlled compared to the rest of the chaos that we've seen in crypto.
Yeah, it's quite interesting. It seems maybe that people are distinguishing between crypto, the people and the companies, and crypto, the asset. And maybe you would have imagined it would have dropped to like maybe 10,000 if we imagined a chaos of similar, you know, proportions.
Okay, more analysis on crypto later in the program. Let us thank you then to Bloomberg's Anna Herrera. Let us get back to another story we're following today. Negotiators at the UN COP27 climate summit have reached an historic last-minute deal on payments for climate damages. Let's get to Bloomberg's Jennifer Sabasaja, who joins us now from Sharm el-Sheikh. So, Jen, what has been agreed? They've managed to agree something around the amount of support to poorer countries, but not around increasing targets for emission reduction.
Exactly, Anna. And this was a win significantly for a lot of developing nations who have said for 30 years plus that they wanted loss agenda on the agenda item. So this was significant that a fund was actually created out of this summit. And what it will do is sort of the next step for the transitional committee that is going to be formed leading into COP28. Right now, we don't know the financing structure. We don't know which countries are a part of it. So still a lot of work to go on that. But when just talking about the failures, the disappointments that people are feeling out of this COP, it was really on this front with mitigation. There was not stronger language taken from COP26 in Glasgow this year. There was not a decision to include the term phase out all fossil fuels and just phasing down like what we saw last year. So a lot of disappointment from a number of leaders who were hoping that would get us on a better path to keeping temperatures below that 1.5 degrees Celsius. But there were still some positives coming out of it. There was a number of climate finance projects that were announced by the private sector, also some public sector support for countries like Vietnam and Indonesia to transition out of fossil fuels. So some positives and a lot of negatives, but a lot of mixed results coming out of this COP27 and really a lot to still work out going into COP28 that is going to be hosted in the UAE, which is, of course, a major oil and gas producer. So many climate scientists and activists are worried that maybe this goal that we had is maybe diminishing just leading into the next year.
All right, Bloomberg's Jennifer Sabasaja reporting from Sharm el-Sheikh, Egypt. Thank you so much. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. And really a lot of these names come back to that China story. Concern around the reopening maybe not happening as cases and deaths start to tick up. So that is weighing heavily on Chinese technology stocks with listings here in the U.S. Alibaba down 3% for those ADRs. JD.com down nearly 5%. And it is also weighing on casino operators that have heavy revenue exposure to Macau. Las Vegas sands, wind resorts, each also under pressure, down between 3 and 3.5% in pre-market trading. And finally, one final note on the crypto story. We were just discussing with Ana Herrera how Bitcoin is sub 16,000. You're seeing a lot of crypto names under pressure as we contend with the fallout of the FTX collapse, and that is weighing on the shares of another crypto exchange, Coinbase, of course, the largest one that is public. Those shares down about 5% before the bell, Anna.
So coming up on the programme, we will get back to the subjects of energy, very topical here in Europe, and business, what it wants from governments at this point. Greg Jackson joins us, founder and CEO of Octopus Energy, an energy provider here in the UK. We'll also talk about markets with Jeffrey Yu, BNY Mellon's senior strategist. What is he making for the big pivot back into the dollar this morning that we're seeing around those China headlines? Plus, on crypto, we'll get back to that story. Lex Sokolin joins us, Consensus head economist. We'll get his perspective on the latest FTX news lines. This is Bloomberg.
And says, I want to be Ari Emanuel when I grow up. What should somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kaylee Lines in New York. Now, the UK Prime Minister Rishi Sunak is set to speak to business representatives at the UK's largest business conference today. In fact, within the next 15 minutes or so. Surging energy prices are among the topics on the agenda. One of the keynote speakers at the conference, Greg Jackson, joins us, Octopus Energy founder and CEO. Greg, when we look at the government and its relationship to business right now, clearly your business very impacted by the budget last week. So what are you looking to hear from the Prime Minister when he speaks a little bit later today?
I think clearly in the short term, it's important that we do everything we can to help consumers through this crisis. You know, the impact on inflation, on their spending power, and critically on their ability just to pay their bills is foremost in the short term. But we also have to build our way out of this, and the answer is being able to deploy, dramatically more capital to build cheap renewable energy here in the UK, and indeed, this is what we need around the world. It's not only going to help tackle climate change. You heard from COP just now, and the critical importance now of getting on with replacing fossil fuels with renewables, but also it helps energy costs and energy security.
Right, and with that in mind, you talk about needing to build our way out, cheap renewable energy. The government has just put a 45% tax on businesses like yours through the electricity generator levy. Where does that leave your investment plans?
Yeah, I mean, at the moment, it's very hard for any company to justify the windfall profits that far exceed anything that was planned, when at the same time you're seeing the damage done to consumers' lives and to our economy. Coming up with a fair solution is important, and these kind of sticking plaster solutions are okay. What matters is giving us the ability to deploy dramatically more investment to grow forward. And at the moment, in the UK and around the world, we face sclerotic grid infrastructure, which means we can't get these new renewables built and connected. We face planning issues that are unnecessary. We've got to learn from COVID, where we took the 15-year regulatory process of the vaccine, did it in a year. We've got to take the 7 or 8 year regulatory process for renewable building and do it at the time it takes the engineering, which is a year.
Greg, I keep reading that, at least from an investor's perspective, the UK and the European energy situation isn't as bad as had been expected. Have we avoided a worst-case scenario for now?
We're right in the middle of the storm at the moment. I think what's happened is, look, Europe responded quickly to the need to start reducing dependence on Russian gas, filling up a gas storage in Germany and across Europe, rapidly building new supply chains to get gas into Europe to replace that Russian gas. We've had a mild start to the winter in the Northern Hemisphere. And so far, the crisis this year is like, prices are still astronomically higher than they were in the past, but, we can be slightly more positive. What we don't know is what the rest of the winter holds. So what really matters now is, are we going to be able to, leave this winter with some gas and storage ready for next year? Or is bad weather going to hit, and then we're going to be scrabbling for more gas?
Are households prepared? I mean, should we be making more preventative, taking more preventative measures, such as insulation?
Insulation takes time. I mean, the first thing is there are lots of low-hanging fruit that households can do. Whether that be, for a lot of households, they can reduce their thermostat by 1 degree C. It will reduce consumption 10, 15% very often, and barely make a difference to comfort. Other households can adjust the way that their, for example, gas furnace, the gas boiler works, and again, save another 5 to 10% of gas. Octopus's customers in October used 37% less gas than last year. That's a combination of warmer weather, but also a lot of behavioral change. What we don't know is how long that'll last through the winter.
Yeah, so interesting to see kind of those demand reductions. Meanwhile, Greg, Octopus is in the process of acquiring Bulb, which is another UK energy provider that collapsed as prices soared. The government had not hedged for those customers. So how did they make that deal attractive to you?
Yeah, so I think, look, first of all, I can't talk a lot about kind of conversation we're having with government. It's going through a technical legal process at the moment. But I think government rules in the UK prevent hedging. And this winter, that has certainly cost the government a lot of money. And the sooner that they can find a route to putting Bulb back into the private sector, the sooner they can give certainty to taxpayers.
Okay, and finally, Bulb obviously is not the first that has succumbed to this very volatile energy price environment. It may not be the last. Do you expect we will see more providers going bust over the course of this winter, possibly the next?
Look, last winter, there were doommongers saying that we'd end last winter with less than 10 energy providers. There's still well over 20. So, I think it's a fool that makes those predictions. But, look, the key thing here is pretty much every company that went bust did so because they were not hedged. We need the regulator and the government to make sure companies are hedged. It's the equivalent in financial services of, selling long and buying short. And without a decent regulatory oversight, you're always going to have vulnerabilities. So the one thing we're calling on is regulatory focus on hedging, and that would secure the sector dramatically better than before.
All right, Greg Jackson of Octopus Energy, thank you so much for your time today. And again, we are watching for remarks from CBI from the UK Prime Minister Rishi Sunak. We'll bring you any headlines from that when it begins. Meanwhile, let's keep you up to date with other news from around the world with the first word. In a newspaper interview, Germany's defense minister says the country is offering Patriot missile defense systems to Poland. Last week, a strike killed 2 people in a Polish village near the Ukrainian border. Germany says it also intends to extend a deployment of Patriot batteries in Slovakia through 2023. The UN's atomic agency says powerful blasts shook the area of Ukraine's Zaporizhzhia nuclear plant over the weekend. Former Treasury Secretary Larry Summers warns U.S. policymakers to focus on building the country's own economic strengths in its contest with China, rather than attacking its adversary. Summers tells Bloomberg the U.S. should instead concentrate on its own innovation, infrastructure, education, and challenges such as opioid deaths. The world's biggest single sporting event, soccer's World Cup, has begun in Qatar with a lavish opening ceremony. The Gulf state's been under intense scrutiny leading up to the tournament over the treatment of migrant workers who built 7 new stadiums, as well as concerns about human rights and its criminalization of homosexuality. And it wasn't the start the hosts were hoping for on the pitch either, beaten 2-0 by Ecuador in the opening match. And American musician Ye, of course formerly Kanye West, returns to Twitter after a 2-week hiatus from the social network, and the new owner Elon Musk welcomed him back to the platform. Ye's account had been temporarily suspended and restored at the end of October, which Musk said was not his decision. Ye's earlier suspension had been due to an anti-Semitic tweet. And of course, it's not just Ye that has made his return to Twitter, or at least could in theory. Former U.S. President Donald Trump, who had been banned from the platform in January of 2021, also has had his account restored, but I just checked, Matt, he has not yet tweeted. Of course, he tends to stray toward Truth Social these days.
Yeah, these days, but the question is that going to be enough reach for him? Does he need to go back to Twitter? Elon Musk had tweeted a pretty cool meme with Lois from Family Guy, like shaking and looking at a prescription drug bottle, like she needs those drugs. Does Trump need Twitter? Maybe he will if enough people aren't reading him on Truth Social. Certainly he's not getting swing voters that way, Anna.
Yeah, I mean, some of the memes that Musk was posting are funny. Some of them seemed in pretty bad taste. But interesting to see the poll that he conducted around President Trump, then, Kayleigh, and the fact that he'd said he was going to set up a board to evaluate this kind of stuff, and then he just decided to decide via asking his followers. And would you believe it? The result was 48-52. That seems to be the kind of divide we get in all kinds of political situations these days.
Yeah, definitely a split, Anna. But on the point of Elon Musk's decisions, it is interesting to see him restoring accounts that frankly were deactivated for a reason because of concern around the spread of false misinformation and also anti-Semitic and other hateful content. When Twitter already is contending with advertisers pulling back from the platform because they're uncertain around the company under the leadership of Elon Musk, concerned that perhaps their advertisements will be running next to misinformation or hateful content, it raises a question of the business decision of restoring some of these accounts and if this is just going to push people further off the platform.
Yeah, it's going to have an interesting impact on that ad revenue. We'll watch that very carefully. Back in the markets then, we'll talk to Jeffrey Yu next, BNY Mellon senior strategist. We're seeing money flooding back into the dollar today. All those headlines around China, of course, making investors very nervous about what the reaction function is of the Chinese government around COVID. Yes, cases are rising. Sadly, deaths rising too. What kind of lockdown strategies will we see? Will they look like the old playbook that we've known through COVID-0 from the Chinese government? We'll get back to that conversation shortly. And what does that mean for investment strategies more broadly and globally? This is Bloomberg.
We've invested more than $10 million in our employees over the past year, and we're going to continue to invest more. We're testing 4-day work weeks to help, especially our working parents kind of juggle that balance between childcare and their work. I know I deal with that all the time. This is really a people-first company. Even in an inflationary environment, you're going to see us continue to lead with our people.
Do you worry at all about a price wage spiral, not just here, but in the industry, in the economy?
Yes, and I think that, this is something that, many business leaders are focused on, and, time will tell kind of how all of this lands.
I think the wage price spiral continues for quite some time, and I think we probably have been a lot less aggressive than we can be, and than many other companies have been.
In terms of raising prices?
Yes, we've taken our time. If you look at a 20-year history of pricing in this company, we've taken about 2% a year on average. We've never taken what we could. We've always taken what we should. We have to pay people more. We have been, and will continue to do so. We'll take a little bit of a margin compression on that as we've had to, and I think that's the right thing so that for the long term, Shake Shack continues to be what we're building, which is the next generation's burger joint.
In a multi-trillion-dollar industry, there's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. Disney's surprise, Bob Iger is back as CEO after a string of disappointing results and a slumping share price. Far from zero, China's first COVID-related deaths in almost 6 months have sparked concern that Beijing could see a return of heightened restrictions. And $3.1 billion, that's how much FTX owes its 50 biggest unsecured creditors. We've got the latest on the ongoing crypto crisis. I'm Anna Edwards in London with Matt Miller and Kaylee Lyons in New York. Matt, the crypto story, the Twitter story, plenty of individual business stories and indeed stories that risk contagion to follow. But in terms of the broader markets, we've got this Chinese story coming through and having a bit of a downward impact on US futures. At least something is pushing them lower.
Yeah, no, the Chinese story is huge, right? Because it turns around a lot of the narratives that started to look like they were driving the market. For example, we thought, okay, there are a lot of short positions now in the US dollar. The greenback is going to start to weaken against other currencies around the world. Now we're seeing the US dollar index, the Bloomberg US dollar index here in the second row, strengthen against other currencies around the world. You may also have thought, okay, if they start to unlock big cities in China, a ton of people are going to be driving. There's going to be huge gas demand. We can expect oil to start to bounce back higher as demand comes back in the picture. Well, oil is now back lower, again under $80 a barrel for, this is West Texas Intermediate and IMEX crude, but you can see the same thing on the global benchmark Brent. We're coming down on concerns that demand just isn't going to be there regardless of the supply cuts that OPEC puts into force. All of this, of course, is pressuring S&P futures in a downward manner as well as other indexes around the world. Right now, we're at 39.51 on futures. We're at 39.56, I think, on the cash trade. We were up about 0.5% on Friday, but that's now turned back around. And then Bitcoin, also looking at some downward pressure, but still higher than 16,000. We had dipped below 16,000 temporarily. That is seen as a support level for the cryptocurrency, but it's now back up there. And the question is, will this contagion spreading out from FTX, all the customers that were owed $200 million, $100 million, $50 million, and looking to put a big zero under that, is that going to hurt across, I think as someone put it earlier, are those creditors going to have creditors of their own? Kaylee, what do you see in terms of pre-market effects?
Well, I have to begin first with one of the shock corporate stories of the day, and that is Disney. A surprise ouster of Bob Chapek, the CEO, the prior CEO, Bob Iger, who stepped down in 2020 after leading the company for 15 years, is back in. He will be CEO for another 2 years while they search for a permanent replacement. He's going to be charged with turning things around for Disney stock, which is down more than 40% so far in 2022, but it is higher by 8.2% on that surprise news of the morning, massive move for Disney. But back to the crypto story you were mentioning, Matt, the kind of ripple effects, contagion concern around FTX and the fact that Bitcoin prices are lower. That's dragging on really the entire crypto complex, including Coinbase, of course, a rival exchange, which is down 5.2%. And then to the China story that you and Anna were mentioning off the top, they're concerned that the reopening of the economy maybe is not actually going to be coming so soon as cases rise, and the first deaths in the country were reported in 6 months over the weekend. So JD.com down 5%, Alibaba ADRs down about 3% as well, Anna.
Kaylee, here in the European session, then I just wanted to show you the European side of some of the big macro themes that Matt was talking about a moment ago. So we've got the European stocks on the back foot, down by 0.2%, just as we see US futures a little bit weaker. The big global story coming out of China seems to dominate. That pushes money into the dollar, the perceived safe haven of the greenback, and that takes out the pound and the euro. Both the pound and the euro then down around 0.8%, against the US dollar. That's quite a substantial move in one session for those currencies. And Brent crude, Matt was talking about WTI. Here's Brent down by 0.6%. Again, this is related to China, concerns about the growth story there and how long we have to wait for any kind of normalization in the growth story out of China. Goldman Sachs, for example, Kaylee, taking down their estimate of where oil prices get to by around $10.
Yeah, really seeing across asset classes the concern reflected about growth in the Chinese economy. But it raises the question of whether good news is bad news is good news, because a reopened China and spurred demand from China could fuel the inflation problem that countries around the world are dealing with. So let's get the assessment now from Jeff Yu, BNY Mellon senior market strategist, who is joining us from London. Jeff, how are you viewing the China story going into 2023 as we have optimism on the one hand about reopening, question marks of if that's even going to happen, and ultimately what it all means for inflation?
Good morning. So I think the overall sense is maybe markets got a bit ahead of themselves in anticipating some kind of a big bang reopening. I think globally we've noted in the past, and we've seen through experience, that a big bang reopening in the middle of winter, and winters in northern China can get very, very cold. You know, it's quite adverse an environment for a reopening. That was always a bit of a stretch. However, you know, right now what I'm watching is, you know, whether Beijing and some other cities at risk right now, they're willing to sort of experiment a bit. You know, there has you know, been a gradual symbolic, you know, note of that changes, you know, in a more precise way of managing COVID. You know, they're being a bit more transparent, I guess, about, you know, deaths happening. Maybe this is preparing the groundwork for some tough times to come. People are being told, you know, to stay at home rather than ordered to stay at home, at least according to official communiques. So this is going to be stop-start, but a full-scale, let's say, pickup activity. We're still looking at maybe Q2 next year at the earliest.
And when that pickup in activity comes, does that equate to a higher terminal rate, Jeff?
Well, it really depends who you're going to ask, because you know, there probably will be upside surprises to, let's say, services demand and industrial demand in the Eurozone. So I've had to pick between the ECB and the Fed. You know, who needs to revise their terminal views? So from China's reopening, it certainly is probably more to the ECB side. And also, of course, in Asia, that's where you really can revise upwards your terminal rate views and also allow some currency appreciation, right? We're seeing that in the yen, maybe some more interest in the Sing dollar, for example. So different implications for different economies.
And different implications for different assets. Jeff, good to speak to you. What about oil prices down here at 87? I say down because, you know, we've seen much higher prices. 87.07 is where we are on Brent. So once again, below $90. Goldman Sachs taking down their forecast for where oil prices get to. Are different asset classes telling us different things about the global economy?
I really think it does. And also, if you look at oil prices, you know, what's the relationship between oil prices and the dollar, right? So if oil prices, you know, just going down, normally we'd see, well, if it's dollar strength, right, then, you know, that tends to depress commodity prices in general. But right now, I think it's more of a demand story because, you know, we're seeing the dollar weaken, you know, largely due to positioning and valuation issues, and that's normally good for commodity prices, but they're struggling right now. I think that's due to the demand story as well. Again, you know, next year, if China reopens, I do think there's going to be a sting in the tail for prices for commodities, maybe less on the oil side, but on the industrial side, I think that's something we need to watch out for.
Okay, commodities, we'll watch that carefully. Back to the dollar actually gaining in today's session, as we've mentioned, because of risk aversion. But do you then generally see, well, if the dollar has topped out, Jeff, what has it topped out against? What would be better opportunities in FX right now?
Well, right now, for example, in G10, we're looking at euro dollar, we're looking at, you know, dollar yen, for example, yen positioning and, you know, valuations, you know, that's something really to look at. Euro, you know, right now, we've 3 months ago, according to our custody flow data and iFlow, we saw euro holdings reach almost financial crisis and sovereign debt crisis lows. At that point, so we're not too positive on the euro either, but that was extremes. But now we're seeing euro suddenly flatten out. This is one of the strongest recoveries we've seen. So yes, valuations and policy crucially quite supportive, but have had to pick between those two. I'd probably favor the yen strength against the dollar rather than the euro at this point.
So if valuations are getting better, where are you finding the best bargains, Jeff? Are there certain sectors that you like? Are there certain regions that you like better than others?
Well, again, just going back to our flow data, right now, equities are still being sold across the board. I'd say two sectors, worth watching right now. Firstly, if it's still stagflation, you want to own sectors, so defensive sectors with pricing power, and I think that's where utilities have come through. And even in the lead up to the week where we were still quite risk off and seeing, so right before that downside CPI surprise in the US, utilities basically globally the only sectors which was in demand. But now of sectors, especially on the consumer side, exposed to China reopening. This could be in Europe and this could be in APAC as well. That's where we're seeing a pickup in interest. People looking at financials as well. If China reflates, if Chinese curve steepens, that could help APAC financials in general. That may be getting a bit too ahead of ourselves right now, but so we'll stick to APAC and consumer and also utilities for the time being globally.
What about fixed income, Jeff? I mean, have returns gotten big enough? Have yields gotten big enough for you to think it's time to go back? Or is that period already passed?
I still think we need to be cautious on the corporate space. So if I look at corporate credit spreads and have they really blown out pricing and potential a recessionary driven rise in bankruptcies globally, especially in Europe at this point, I think that's something we need to be quite cautious on. The repayments for Teltros last week, what impact is that going to have on overall liquidity in terms of funding credit in the Eurozone? That's something I'm still quite concerned about. However, if we go back to APAC, especially in the credit sector, especially in the property sector for credit, that's something that clients are looking at quite aggressively because of the widening that we've seen and with the support announced by Beijing for property. Maybe we've seen enough widening in corporate credit in property in APAC, but is it really a slam dunk trade? Time to get back. I think we need for the reopening stories to actually gather some legs first.
Jeffrey, thanks very much. Thanks for joining us. Jeffrey Yu of BNY Mellon joining us here on set in London. Coming up on the programme, we'll get back to the fallout from FTX. We'll be joined by Lex Sokolin, who's head economist at blockchain technology company Consensus. How much is he trying to draw a line between FTX and, well, all the others, all the rest? Let's talk about that next. This is Bloomberg.
Stronger that moment that you're lifting the barbell, you get stronger as your body is making repairs, making recovery. Recovery is a when and how you get fitter, faster, stronger.
Recovery technology includes everything from massage guns and foam rollers to compression boots, hyperbaric chambers, cryo chambers, infrared saunas, and even infrared pajamas. And athletes are partnering to become investors to take those products mainstream.
When you look at tech and sports right now, it's completely innovating the way training's going, completely changing the way recovery's going. I think sky's the limit as far as where it can go.
But while some of these products can feel amazing, it can be difficult to differentiate between what really helps the body and what just tricks the mind.
Every time you're chasing the latest, greatest, newest tool, you're probably chasing a mirage.
The top names in climate change are on Bloomberg.
Building out local wind, local solar, hydrogen, these are solutions to not just climate issues, but geopolitical issues. We are in a position by 2030 to have 80% of all electricity generated by wind.
Renewables are the safest, the cleanest, and the cheapest form of energy today, especially for countries such as Greece.
Nobody covers climate change like Bloomberg, your global business authority.
This is Bloomberg Surveillance Early Edition. I'm Matt Miller with Kayla Lyons here in New York. Anna Edwards with us out of London. Now, crypto prices are falling as more details about the downfall of Sam Bankman-Fried's FTX empire come to light. New court papers show the company owes its 50 biggest unsecured creditors a total of $3.1 billion. Joining us now to talk more about this whole issue, the industry and the underlying asset, is Lex Sokolin. He's head economist, I should say, at Consensus. Lex, thanks so much for your time. I want to start with the idea that this is all very bad for Bitcoin or for cryptocurrencies, when it really seems to me to be an organizational problem. It's a problem with centralized finance more than it is the underlying assets. What do you think about the differentiation?
Yeah, absolutely. Thank you so much for having me. I think it's really important to draw this line between the economic activity and the entrepreneurship and the building that's happening on crypto rails that people talk about as Web3. And then on the other side, the financial industry that has formed around Web3, and in many ways is supportive of that. And it can start out as very symbiotic, but it can also turn parasitic and in that way damage the actual entrepreneurship and growth of the underlying technology, of the underlying economy. And so what we've seen as a large failure for about the last 9 months in FTX, in Voyager, in Celsius, in Three Arrows Capital, and then going back to Terra, is we've seen a failure of the financial services industry around crypto. And that looks like a liquidity crisis and a liquidation cascade. It looks the same way as Lehman Brothers in relation to housing, or long-term capital management in relation to fixed income. And of course, it's extremely damaging, but it is not reflective of the underlying economy that's being built in crypto.
I mean, the thing about Lehman Brothers and LTCM, they didn't shake investors' confidence in the dollar, right? Is this enough to shake investor confidence in Bitcoin when, ultimately there isn't much else aside from confidence holding that currency higher?
I think there's quite a bit of discussion we could have on the use cases and the fundamentals of blockchains, and in particular computational blockchains. But if you think about the housing crisis and the Lehman collapse, after that, people still bought houses and they lived in them because they need a place to actually live in. And in the internet boom and bust, after all of the financing and the venture investing and all of those companies went belly up in the early 2000s, it's not like the internet went away. We had more internet companies, more value created. And similarly, the crypto movement and crypto infrastructure, and in particular, the building of software on crypto infrastructure, it's a separate theme from how much we can get levered up in derivatives around crypto assets. So I think that the use cases remain. They're getting more adopted. There's more users on all of the chains. But at the same time, any financial crisis is going to be quite painful.
Okay. Good morning to you, Lex. I mean, maybe you see this as old finance, and therefore, you're not very interested in the views here. But Neil Kashkari, of the Fed, has a very different view on this. He was tweeting at the end of last week that this isn't the case of one fraudulent company in a serious industry. He says the entire notion of crypto is nonsense. It's not useful for payments, no inflation hedge, no scarcity, maybe debate that, no taxing authority, just a tool of speculation and greater fools. You still come up against that kind of view.
Yeah, it's unfortunate that we have these types of views still out there. I think if you engage with...
A lot of people think that. It's not just him.
I understand that it's very tempting to use a broad brush, especially for things that can be challenging, can have different vernacular. But I think if we engage with the underlying data, if we look at how many millions of monthly active users there are on Ethereum, on Polygon, what are they doing? What are they opening up? What kind of applications they're using? What you're going to see is an analogy that's a lot more like an Apple application store with millions of users and hundreds of thousands of developers building stuff. And so I think it's very fair to react to the volatility in the asset class, But again, I think it's a bit of a lazy view on the whole thing.
Well, Lex, as you talk about users, let's also get specific about who exactly they are, because for so long, the narrative in crypto has been institutional buy-in is going to make a difference. It's going to be a stabilizing force kind of in the industry overall. But institutions are the very ones that are probably getting frightened by an episode like this, and really the episodes we have seen over the course of the last year. Where does that leave us if the institutional adoption starts to lag?
Yeah, I think this is a really complicated question with a lot of nuance. I think you want institutional ownership of the asset class in the same way that for equities, you might like to have institutional ownership and wrappers, whether it's exchange-traded funds or mutual funds, around the financial aspects of businesses. And in crypto, again, you want stable holdings from high-quality financial services companies, good packaging of those investments. But if you look at the actual, again, usage of applications in Web3, whether that's people coming together through decentralized autonomous organizations, DAOs, whether it's people purchasing NFTs to reflect culture, whether it's people using other on-chain contracts and software, end of the day, a lot of that is going to be driven by how does retail adopt this new internet. And I think it's, while it's easy, it is a bit of a mistake to just think the whole thing is about trading. I will also say that you've seen increased correlation between traditional risk-on markets, so whether it's equities or other risky investments, and crypto, and that definitely tells us that institutional hands are all over these asset classes, and so they do move together. But the underlying fundamentals of how people are adopting the asset class is very much, how does the software usage go up and down?
All right, Lex Sokolin of Consensus, thank you so much for joining us. Really appreciate it. And for more crypto conversation, make sure to tune into Bloomberg Crypto tomorrow and every Tuesday at 1 p.m. New York time, 6 p.m. in London. On this week's show, we will be speaking with the CEO of Circle, Jeremy Alariana.
And Kaylee, happening right now, the UK Prime Minister Rishi Sunak is speaking at the Confederation of British Industry conference in Birmingham. He's trying to improve the relationship, perhaps, between the Conservative Party and business. Has been in trouble over recent years. And in the aftermath of the budget, the mini-budget we saw and all the turmoil that created, trying to improve relationships. The opposition Labour Party also in attendance. We'll continue to monitor for headlines, and you can watch the whole speech on Live Go on your Bloomberg terminal. This is Bloomberg.
But too often, those firms can't access the finance they need. That's why we're radically...
When I started, I had no idea it was going to turn into this, which is a tracksuit empire. I don't have any investors. All this is all money in. This is me going out and hustling, bringing that money back, and just building it, building it, building it. You gotta think about a person that was homeless at one point, didn't really have any money coming in. The fact that this person was relentless and just determined to succeed and not let rock bottom define him as an individual. I can take things and put them together and take them apart and make them better and put them back together. I respect the craft, so I don't want to minimize and disrespect the value of each step of the craft and do by machine what should be done by hand.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
When U.S. jobs numbers are released, Bloomberg brings you crucial data at terminal speed and instant expert analysis. Nobody covers jobs day like Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lyons with Matt Miller in New York and Anna Edwards in London. Happy Monday, everybody. Let's take a quick look at what is coming up this week. On Tuesday, tomorrow, South African President Ramaphosa will be visiting the UK, the world's first head of state to be hosted for a state visit by His Majesty King Charles. Then on Wednesday, we'll be getting Fed Minutes at 2 p.m. Eastern Time, provide some color on the Fed's meeting from November. U.S. markets will be closed on Thursday for the Thanksgiving holiday. Matt and I will be off eating turkey. Meanwhile, the EU energy ministers will be meeting to discuss the European energy crisis. And finally, we end the week with Black Friday. Discounts are expected to be higher this year to help drive purchases. And all the while, Anna, we will be slightly distracted by soccer or football, as you call it, with the World Cup.
Yes, I will be here through Thanksgiving. I'm just hoping that somebody in this office makes a pecan pie, and then it'll be worth coming to work. But yes, we will be distracted by the football, so it could be a shortened week in the United States and a week where we don't entirely concentrate on the markets here either. A lot of traders will be watching other screens. The 2022 World Cup has kicked off in Qatar. A lavish opening ceremony was followed by an opening match between the host and Ecuador. It's the culmination of a 12-year build-up that's been marred by controversy over the initial bid, human rights concerns, and the environmental impact. Bloomberg's Simone Foxman joins us now from Doha. The result wasn't the one that the hosts wanted last night, of course, Simone, but were they satisfied with how things had kicked off?
Yeah, I think so. I mean, the opening ceremony in particular was pretty stunning. There were lots of world leaders in attendance, particularly regional leaders. President Abdel Fattah el-Sisi of Egypt, President Erdogan of Turkey shaking hands for the first time, and also Crown Prince Mohammed bin Salman talking very closely with Gianni Infantino. But I think one of the things that's going to bring the controversy home yet again is a new decision by FIFA not to allow, or at least threaten, sporting sanctions against players if they wear rainbow armbands. These are the One Love armbands that were meant to be worn by captains of the English team, Danish team, 7 actually teams coming out and wanting to wear these. But FIFA's decision has encouraged these teams to tell their captains, no, you can't. However, this kind of adds fuel to the fire around all these controversies, right? In telling these captains they can't kind of demonstrate their free speech, demonstrate their support for LGBTQ rights, and obviously can't follow what the activists have told them, which is highlighting the controversial human rights issues in this country and around the world as a part of being players on the field.
Simone, thank you very much. Bloomberg Simone Foxman in Doha. England plays Wales later. Matt, I'm sure this won't have escaped your attention. You'll be glued to the screen, no doubt. That was sarcasm, by the way. But maybe for the England-USA game, that happens a little bit later on?
Yeah, no, I love watching...
Sorry, England-Iran, I should have said. That's what I meant to say.
That one I probably will give a miss. But if England plays the U.S., I'm very likely to watch that. And any of the big matches, I love to watch World Cup football. But I prefer to watch it, I think, from the television in my house rather than in a stadium built by people who maybe didn't want to build it in Qatar.
Yeah, there we go. Right, that's it for Early Edition. Surveillance is ahead. They'll be hearing from Carl Weinberg of High Frequency Economics. Among others, commenting on the global economy, this is Bloomberg.
successful company, but you might not want to run it for the next 10, 15, 20 years, or do you? And if you didn't, would you want to go into government? If the president called you to serve our country, would you go into government, or would you start another company?
I love what I do. And I feel like I have this luxury with 23andMe that it keeps evolving. You know, we started out just as started out a consumer company. We're thick in research. We got into drug discovery in 2015, and now we're getting to the delivery of care. So I've been really lucky with 23andMe that it's been endlessly interesting. And I'm surrounded by incredibly talented, brilliant individuals where I learn from them. And what I always advise people to do is, like, you should take jobs where you're learning. And if you stop learning in a job, then you should quit. And, like, frankly, when people leave 23andMe, like I say, if you're not learning anymore, you should move on. So I'm 100% committed to 23andMe. That said, my other passion is other direct-to-consumer. Like, I want to build out a true consumer-empowered healthcare world, like one that is outside of the existing system. And there's no greater force than government.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
There's no doubt about it that inflation is the key to market direction.
Eventually, we're going to see a more significant pullback in risk assets and equities.
Right now, it's a market that's trading on whether inflation is coming in better or worse relative to expectations.
The Federal Reserve funds rate is going to go above 5% up to 5.25%.
This narrative of now pivot to pause is one that is just not yet backed by the Fed.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene. A holiday lengthened work week. Good morning, everyone, on radio, on television. A really eventful week coming up with lots of mystery, including, we're going to get to this, Mr. Iger rejoining Disney and all the rest. China we've got to talk about as well. But the major discussion at my house, Lisa, was simple. Ina Garten, do you put sour cream in your mashed potatoes?
Yeah,
these are the kind of discussions this week that matter.
The big week. It's the biggest, most eventful week you could ever imagine. Right. How much are we going to fight over the turkey to see whether we put sour cream on it and whether we discuss Bitcoin over the table? I really do wonder. I mean, honestly, this is not a very eventful week.
Monday, Tuesday, Wednesday.
Yeah, exactly. It's pretty good. But what we are getting is a lot of year-ahead reviews. And I find that interesting because they're coming out during this holiday-shortened week.
Exactly.
Maybe don't look at this. We'll revise it in March. And you're getting them. And there are some consensus trades that you're starting to feel, even in the turmoil that we're seeing.
Yeah, we're going to talk about that as well, including some disinflationary talk. Chef Patel will join us here to start us off. Margie Patel will join us in Boston here in a moment. Just let's very quickly go through some of the immediate headlines. I'm not surprised. This is a cultural issue. Iger back in at Disney, not as chairman. And I'm sorry, I've always said this. Entertainment is about creative, and what this was is a failure of creative. Iger comes back in to jumpstart Disney creative.
What this is about Walt Disney Company facing its worst year of stock losses, potentially going back to the 1970s.
But they had a lot of company.
They had a lot of company, and yet they are uniquely in pain due to perhaps the amount of money that they're hemorrhaging from Disney Plus, trying to rationalize the $1 billion+ of losses that they've seen there. How much does he really revive that, considering that Bob Iger kind of founded some of these online streaming movements?
Stock 203 down to the 86 level, I believe, and then up to 90 and up nicely at today's. We're going to talk a lot about this. We're trying to effort some of the true experts on this. But again, Lisa, to me, everything here is culture. Wall Street's culture, entertainment, the pixie dust of Hollywood is culture, and this is just a cultural discussion. Chapek out, Iger in.
And it's the culture also of activists getting more involved. Suddenly you have more activist investors that are going to be kind of pushing things around a little bit more. The other aspect of this is how much are we going back to a pre-pandemic norm for some of the entertainment companies, some of the tech companies that really built up in 2020, in 2021 when they were the only game in town. And I wonder that was some of the tech layoffs, right? Twitter is unique with 75% of the staff cut.
Yeah.
But is it, right? I mean, are we going to start to see layoffs that start to seem pretty momentous?
Yeah, and I like the phrase somebody had this week, tech session. I thought was pretty interesting,
good.
and you wonder if it expands out from that. We've got to talk about China. Yesterday afternoon late, I said to someone in the family, I said, this isn't normal. This is 200-300 cases. Maybe it was in Beijing. I can't remember as well. Boom, in the Chinese Monday, they begin to recalibrate.
The first death from COVID in quite a while in Beijing.
3 deaths,
87,
yeah.
the 87-year-old man starting that off. And so you start to see curbs come back. But this really speaks to how much hope was baked in the market that perhaps China would move away from zero COVID, even though China kept saying, no, we're not. No, we're not. And so here you are. You're seeing that a little bit in some of the price action, but there is a feeling that China has to move away eventually.
Enda Curran scheduled to join us. Let's get right to the data here. Yes, it's a holiday week, but yes, we continue to watch equities, bonds, currencies, commodities, futures with a weight to them, -21. Dow futures, same kind of idea. Actually, Dow is a little bit better on a percentage basis. NASDAQ down 0.7%, and the VIX was a 24 level, 23.93. I'm going to go right to it. We had a 15,000 handle on Bitcoin. It is fragile this morning, 16,114 down fractionally, but 15,000 handle is not 16,000 reality on Bitcoin. In the bond market, Lisa, help me here. The 10's 3.83%. 2-year, you know, I'm going to call it a churn of non-news, and yet there's that inversion still negative 71 basis points.
People expect the Federal Reserve to have to hike rates pretty substantially into weakness, and that is going to lead to further curve inversion. I'm curious to see whether we get any Fed speak that really discusses that.
And before, this is really important, I think it's a sleeping time bomb. West Texas Intermediate, American oil, 79.70, and for American oil to migrate down into the low 70s would be a huge deal in this holiday week. It's amazing to see oil come down. Are you briefing today, or because of the holiday are we brief free?
I'm briefing, but brief light. So let's just go through it real quick. The Fed speak that we get today, we do get some. San Francisco Fed President Mary Daly speaks from 12 p.m. Eastern to 1:45 p.m. How much did she talk about what we've seen in terms of what a pivot means? And this is something that's important. People are talking about a pivot, meaning the Fed stopping. Other people saying no. A pivot is when they actually move from a restrictive to a less restrictive stance, which isn't going to come for a very long time. We also get auctions today.
I've said, we'll get to the auctions in a moment. I want to do shout out Mary Daly. I think she is the most interesting Fed official with first order economic skill, and she came from a really tough background. This is not some person that grew up in the suburbs with a silver spoon in their mouth. I think she's got a very unique perspective for Fed officials.
Becoming hawkish as you see people in the lowest incomes seeing the most pain. She really brings unique perspective to this. We're also going to be getting earnings today, including from Zoom Video Communications after market. This is a chart of their stock over the past 5 years. Kind of shocking to see the round trip. We got as high as nearly $570 on the shares, and currently they are trading at substantially less than that. It's just sort of shocking to see how much of a round trip, $81.64. I'm curious to see whether they can deliver on that. And then today, this is what everyone's actually watching, which is the World Cup. And the games that we have today are England versus Iran at 8 a.m., Senegal versus Netherlands at 11 a.m., and U.S. versus Wales at 2 p.m. Secretary of State Tony Blinken will be attending that game.
Secretary of State John Farrow looking towards the 8 a.m. England, Iran. There's, I skim it. Honest to God, Lisa, I'm like you. I really don't focus on it. But after the 14th article in the Telegraph in 3 hours, you sort of skim the headlines. And at the minimum we can state, boy, do they take this seriously. I mean, it's England, Iran, but they might as well be playing Germany today.
We do too, and we'll be talking more about that later on because we're such experts in it.
Right now, Margie Patel will join us, and we start strong. This is in Lisa Abramowitz demanded that we start with Patel today, and we do. Margie, thank you so much for joining us. I was talking about you cooking up a storm in Boston this weekend with the distressed bird. I'm sure you'll make something of it. How distressed is the bond market?
The bond market is in very good shape, particularly high yield. In fact, I would say, if anything, there's actually a supply scarcity of good quality high yield paper to buy. So we've had yield spreads widen out only 100 or 200 basis points more than the Treasury move. So high yield bonds year to date have far outperformed Treasuries, investment grade. It's really more lack of supply for buyers to buy, and defaults are under 2%.
Michael Darda in his weekend note is heated that the market is wrong on higher. He's looking for inflation and rates will fall meaningfully. That's an opportunity for Margie Patel. Given a disinflation or price up, yield down, where's the best place to play?
In the bond market, I think that better quality high yield is a very good place, because if we have a real slowdown, if we have deflation, we may see defaults go from 2% to 4 or 5%, their historic average. So that says take a little bit of risk and say a double B name, get less yield, but you'll be able to keep it and not lose your principal if there are higher defaults.
How much are you looking at stocks underperforming next year? We got some outlooks from a number of Wall Street banks, and pretty much they are unanimous that next year is not going to be great for U.S. equities. Do you agree?
No, I really don't. I think it's really, at this point, up in the air. A lot depends on what the Fed does. If the Fed slows down their very rapid rate of increase, will that allow us to avoid a recession? I think on a relative basis, we'll still be better off than just about any other country in the world. And because people are so wary of this risk, that says to me maybe there's a lot of money on the sidelines that would like to come in if it looks as if the air is clearing and the Fed is stabilizing, or we miss a recession.
Can you do it at the headline index level, or do you have to be perhaps a little bit more sector specific based on what's happening in tech?
Well, I think you have to look at sectors. I think that technology has had a lot of problems. It's one of the big underperformers this year. But if you go back, say, to 2000 when the market crashed, tech was much, much more overvalued. The crash was much bigger. The recovery took much longer. This time, a lot of tech names, some of the semi names are very reasonably priced for their long-term growth. Still volatile, but the PEs are down closer to what the expected growth rate will be. So we think a lot of parts of the tech market is pretty attractive here.
Margie, you have been fearless about looking at equities for dividend growth and as an income trade. Is that true now?
I think so, because you've had such a big correction in equities. You really put the dividend yield, the cash flow yield, where it is actually competitive with investment grade bonds. So if we have any kind of a growth in the economy next year, it says to me equities will outperform. I think 23 will probably be a rather muted total return year, but I still think equities will do better than bonds.
Margie Patel, thank you so much with Allspring Global Investments. Just wonderful. And good luck with the distressed bird as well. Lisa, John from Coventry emails in front of the TV set just before England, 2 hours away from England. John says, Tom, you went right over the auctions. What the hell are you doing? The auctions today, there are 2 auctions?
How dare you? I mean,
I
honestly,
know.
this is
It was
pretty
bad
much the
form.
most important
John would have
aspect
sat
of the
on
day. Well, we'd basically be blowing up the show. It would be auction Monday ahead of Thanksgiving. 1 p.m. we get $54 billion of 13-week bills and $43 billion of 5-year notes. The 5-year notes are most interesting to me. How do we deal with longer-term inflation? That has been the biggest distinction that I've seen over the past couple of weeks. Suddenly, people are starting to talk about disinflation and outright deflation in a greater number of different sectors. Do you get that feel in some of the auctions? Does the auction do really well? Do people flood in because this is an area of yield?
And in this week, as Lisa mentions, we begin to look forward to 2023. We'll keep you abreast of the different global Wall Street reports on that, I should say. Futures at negative 21. Oil, I'm watching 79.70 West Texas Intermediate. Bitcoin, 16,000.
Keeping you up to date with news from around the world with the first word, I'm Lisa Mateo. Well, Chinese stocks and the yuan retreated as a string of reported COVID deaths and tighter restrictions in some districts gave investors a rude reminder that the path to reopening will be rough. A city near Beijing that was rumored to be a test case for restrictions across China has asked residents to stay at home for 5 days, a potential sign officials are reverting to tighter COVID zero curbs. Meanwhile, the country's first COVID-related death in almost 6 months has sparked concern that Beijing could see a return of restrictions. The U.S. and Chinese defense chiefs are likely to meet for their first talk since Beijing suspended dialogue with Washington over House Speaker Nancy Pelosi's August visit to Taiwan. A Pentagon spokesman says U.S. Defense Secretary Lloyd Austin would welcome a meeting with Chinese Defense Minister Wang Fenghe. Now, it's the latest sign that ties between the two nations are stabilizing. The COP talks in Egypt have ended with an agreement to help developing nations face the devastation of climate change. Although that deal is for a loss and damage fund it paid for by rich countries, is seen as a breakthrough, but negotiators failed to agree further cuts in CO2 emissions. Equity investors hoping for a better year in 2023 will be disappointed, according to strategists at Goldman Sachs Group, who say the bear market phase is not over yet. Strategists including Peter Oppenheimer and Sharon Bell predict markets will reach a final trough next year before a strong rebound. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
To name a couple of your babies. I don't know if I'm asking you to choose amongst your children, but some of the most recognizable buildings by you, of course, the Millennium Bridge, London City Hall, the Reichstag, and the Great Court British Museum. What was your favorite project to do?
The Reichstag does stand out because, first of all, it's an energy manifesto. So it transformed something that was dependent on fossil fuels. It uses all the technology to produce something which is essentially carbon neutral. And as a public building, that's a statement. It's a symbol of a city. It's a symbol of a nation. It incorporates works of art. It's recycling an existing building, which, as I mentioned earlier, is the ultimate in sustainability. If you can give a new life to a building, it also creates public space at the roof level. It is the most visited parliament in the world, so it puts the public above the politicians who are answerable to them. And that, of course, was made possible by the politicians. So it's a demonstration of democracy in action.
Welcome to the world of decentralized finance.
I'm going to take a look right here at regulation.
We are seeing digital currencies under some pressure.
Bloomberg's covering all things crypto. The people.
I want to have some of my money outside of the sovereign.
The transactions.
It all comes down to the details here.
And the technology.
How does that affect disruptors like you?
What happens to everything that you're investing in when the last Bitcoin is mined?
Bloomberg Crypto, Tuesdays. Lots happening on Wall Street.
I'm quite encouraged. The center is holding.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
A lot of these areas still have very, very good valuations.
From businesses most influential and instrumental.
It's knocking it out of the ballpark.
Now's not a great time to be speculative. It's time for a pivot.
We're talking about a significant hit to our standard of living.
Bloomberg Wall Street Week, live tonight with replays all weekend on Bloomberg Television and Radio.
We're in the early stages of a sustainability revolution that has the magnitude of the industrial revolution coupled with the speed of the digital revolution.
Nobody covers climate change like Bloomberg, your global business authority. The top names at the Fed are on Bloomberg.
I think it will probably be appropriate soon to move to a slower pace of increases, but we have additional work to do.
Nobody covers the Fed like Bloomberg.
We in the United States probably need to be careful about our evangelizing influence. I don't think it's really for us to tell China how they should organize their entire society. I think we're going to need to be very careful with respect to our diplomacy.
Lawrence Summers there, committed to Wall Street Week, and we thank the former Secretary of Treasury for his comments on an often basis here on his economics, and also, of course, the way economics folds into the Atlantic and Pacific society. Lisa Bramwitz, Tom King, John Farrell's off today, looking towards England and Iran. We'll do that in an hour and 45 minutes. We'll keep you abreast of that with surveillance World Cup coverage as well. It has not been a surprise, but yet here it is. In China, there is again rising COVID. Enda Curran joins us now, Chief Asia Economic Correspondent here. And Enda, you and I were talking about the symbolism of a hospital in Hong Kong from the 1930s, the Queen Mary Hospital, which is maybe where those tea leaves are discovered in your Hong Kong. Is Hong Kong like the rest of China with COVID, or are there certain zones where things are worse?
There are some parallels, Tom. Hong Kong does have rising cases at the moment. People are watching what's going on with the hospitals, and there are warnings that the hospitals are filling up again. Now, if you extrapolate that to what's going on in mainland China, well, there we know that cases are surging. We know that we've had the first reports of fatalities in 6 months, and we know that we're heading into winter in China. And of course, all the warnings throughout the past year or so since the arrival of Omicron, which has tested COVID-0, has been all about can China's hospital network withstand an outbreak, especially China's regional and rural hospital network. There are plenty of experts who say it will be put under a lot of pressure. And of course, is the vaccination rate, especially among the elderly, at the kind of level that you need to protect your populace. So,
in our reporting this morning, folks, and this is the depth of the Chinese reporting at Bloomberg, we have age 80 vaccination with booster only at a stunningly low 40%. That equates to, I'm going to say, 90% in America. Is this the moment, Enda Curran, where Beijing gets on a first-name basis with Pfizer in Moderna?
Well, you know, China have not embraced the Western vaccines. They certainly have been pushing their own Sinovac vaccine. There's never been a good explainer, though, I think from the outside looking, as to why the vaccination rate among the elderly hasn't been at the level that it could and should be. Tom, there's a view that China has wasted the good COVID years when it was keeping the disease out and not getting the population inoculated. By the way, similar story in Hong Kong. There were parallels to the elderly population here were not protected, and when it broke out then, we had a major crisis on our hands. So there hasn't yet been a satisfying explanation, I think, on China's vaccination rate, but there is a lot of focus on, A, do they start to ramp that up among the elderly? And then B, to your point, where do they go with the Western vaccines and therapeutics? Do they eventually embrace them? Do they allow them to be used in the populace? These are core metrics or core signposts that people are looking out for, I think.
And this doesn't sound wonderful. It's not as terrible as it has sounded. And yet, when you take a look at the Wall Street analysts' expectations for 2023, almost universally, they are all overweight China. They all expect some sort of recovery in the stocks and bonds of the second biggest economy in the world. Is what you're seeing on the ground consistent with that we've seen the worst, and now it's just going to be about recovery and how quickly this nation can do that?
So two things are going on. We had that pivot, Lisa, on real estate, as you well know, a couple of weeks ago. Basically the message from the government was continue to support the real estate sector, the banks and everyone involved. That has lifted expectations for China's economy. Economists are saying that's a game changer. And on the other side, on the COVID side of things, we had that pivot. We can argue what the extent of it, but we had that signaling from Beijing that they are on a path to COVID-0. Eventually, we have had messaging even today in the state press saying let's not have the broad-based lockdowns or mass testing we've had. Let's be more targeted and smarter in containing COVID. So that's what's buoying the optimism for China that maybe there is a way out. But let's not forget, we are going into winter now. It's going to be a huge test of how they do navigate COVID, especially their trajectory to move away from COVID zero. And of course, on the other side of things, we have the real estate story has a long way to go. Both COVID has a long way to go in terms of lifting all restrictions, and the real estate story is far from ending its slump as well. So there's a basis for optimism that maybe it's hit the bottom, but that doesn't mean a full recovery is in any way underway just yet.
How does the Tony Blinken trip to China really shape this narrative as well heading into next year?
It's more about good mood music, Lisa. Again, there's a view that maybe the US and China have put things on hold for the moment, have called time out on those tensions. Again, nobody's talking about any of these structural underlying issues being resolved. But when you have the governments, the officials talking to each other on climate change or on security or on economic matters, the thinking is that's obviously bodes well compared to where they were before the G20 meeting between the two leaders. Right. So I would say better mood music, but it doesn't solve any of the underlying problems.
And very quickly here, are you sliding like a 12-hour work week here in football mad Hong Kong? I was at the Concord Hotel there once, and there were 4 games on at the same time. I mean, does Hong Kong stop for the World Cup?
Hong Kong is a big football city, Tom. Absolutely is. The difficulty this time around is the time zones or the time of the games over in Qatar aren't great for us. So I don't think anyone expects the bars of Wan Chao Lang Kwai Fung to be as packed as they were in previous World Cups. But there will always be the diehard fans who will be out and about watching it for sure.
See how he said that? He slid by. Did you see how he said, but Tom, you knew the answer to that.
Of course. Well, we did our, World Cup chat.
Enda Curran, thank you so much for providing color. And seriously, no one that talks to team surveillance does it like Enda Curran in his late evening in Hong Kong. You mentioned earlier the view to 2023. Anthony Dwyer and Michael Welch at Canaccord Genuity out with a missile, and it's for Dwyer. I mean, Dwyer's an optimistic guy. I mean,
this is not an optimistic note.
The U.S. will be Wales, and this is not an optimistic note when bad news becomes bad news. And look at that, don't buy the pivot.
Yeah, if a recession is coming, don't buy the pivot. Basically, this is something that John's talked about, which is if the Fed does not cut rates into a recession, if they hold rates where they are and the economic trajectory is slowing, that is restrictive, even if they're not hiking further. And Bank of America put this out well. They said, to us, a pivot isn't stopping with rate hikes. It is cutting. And that is not going to be necessarily on the table for a while.
Well, it's going to be interesting to see, but certainly for Mr. Dwyer, who's made a career of linking equity drops to recession, this is a unique note. He says, here's a recession, and he has trouble going long.
So Morgan Stanley's Mike Wilson over the weekend coming out today, he basically was defending some of the hate mail that he was getting on his projection that the S&P could fall to 3,000 before going back to where it is right now. It's about a 24% decline from where we are now. And he basically said that people are pushing back, saying, you're crazy. And he's saying, look, we have to have some earnings pain if you're going to see the recession that so many people are expecting.
We will see. We've got a wonderful set of guests coming up. I was actually thinking this weekend, I hope we can get Dr. Weinberg on. Carl Weinberg is going to join soon. Futures at negative 21, Dow futures negative 79. The VIX elevated a bit of tension, 23.95. Stay with us. Bloomberg Surveillance.
can somebody do to get into the talent agency business or the business you're in?
Well, it's hopefully what I've taught my kids. You got to be intellectually curious. You got to be, you got to show up. And you know this like I know this. I got on a lot of planes. You just, even though that voice in your head is saying, oh God, I'm so tired, I don't want to do this. You got to show up. You got to be charmingly relentless. You have to build emotional endurance, because there's no straight line to success. It's kind of all over the place, and you have to just be able to work through those things. And then I think one of the things that I do every week is I try to create serendipity.
No one covers the world like Bloomberg.
My team thinks 2023, we avoid a recession. I'm a little more skeptical about that.
China and the U.S. both do not want to see nuclear force on the European continent.
The regulators here in the Bahamas are ongoing with their investigation into FTX.
With unmatched reach and resources from more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, your global business authority. A multi-trillion-dollar industry. There's a lot of ground to cover.
Commodities got absolutely crushed.
We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ. Monday on Bloomberg.
Bloomberg Serenos, good morning, everyone. Lisa Bramwitz, Tom King. John Farrell on assignment this morning at 8 o'clock. Scheduled in Doha, England, Iran.
Is that his assignment?
That's his assignment today. You know, it's like a World Cup assignment that nobody's, you know, I mean, can you blame him? I mean, the guy's encyclopedic on this.
Can I go on assignment?
I can't wait for him to get back.
I think we should all go on assignment.
I mean, the final's December 18th, so we got a long way to go. There's like 14 brackets, and you know, did you watch yesterday?
I watched the highlights, and I felt really bad for the Qatar team, honestly, because their nation had built up this entire ecosystem around it, and then they just froze. They didn't show up, and Ecuador absolutely crushed them. Nobody was left in the stadium, and so you wonder whether they can bring it back. 3 mandated games, right?
Television's clicking off, radio stations changing worldwide as you and I talk football. Let's move on. Futures negative 21, and of course we're watching Disney. We'll have some coverage of Mr. Iger back to Disney as well. We just spoke to our wonderful Enda Curran in Hong Kong about the moment again for China and COVID. Right now with the data, negative 21, rates are giving me no help today. Oil a little bit light, 79.68 on West Texas Intermediate, and some dollar strength finally. We catch up on a narrow topic with Carl Weinberg. He's chief economist, managing director at High Frequency Economics. Dr. Weinberg, I have noticed, it's not my chart of the year, but it well could be, the Bloomberg Financial Conditions Index compare between the United States and the EU has never been wider. Europe, on a financial conditions basis, is flat on its back. What does that mean for the ECB in terms of their efforts to be responsible and to do quantitative tightening?
Hey, good morning, Tom. Thank you for finding something on Bloomberg that even I couldn't find in terms of the Financial Conditions Index. What we're looking at, what we're highlighting to readers of High Frequency Economics this morning is a huge change in what you just described. The ECB's monetary stance is going to take a huge step tighter on Wednesday morning specifically. They have raised the rates on their repos. Banks have the opportunity to pay them back. They've signaled 296.2 billion euros worth of long-term repos to be paid back on Wednesday morning. That's going to increase the stock of bonds available to the market by 296.2 billion euros in one day. And that should be a massive step toward reducing the money supply, getting rid of the excess cash balances that are out there, and more importantly, increasing the supply of bonds and raising long-term yields.
Well, if they do this, and I'm going to use a phrase from Jean-Claude Trichet, he would talk to me about how economics diffuses differently through Europe. I get that if we do QT in America, what it means for Montana and Mississippi. How does it diffuse across these nations?
It is a slower process in Europe to get the impact of this out into the market. When the Fed undertakes QT, it sells bonds to the market. So people immediately exchange liquid cash for less liquid or illiquid bonds, and that immediately affects their behavior. In Europe, the bonds are being returned to the banks. They were held as collateral against repo agreements. So the banks then will take their time, or whatever time they take, to sell those bonds back to the market. Because why on earth would a bank want to be holding a bond when the price of that bond is sure to fall? Right, they're better off in cash. So I think those bonds will get to the market, but it will take a little bit longer than the QT impact does in the United States.
As Tom says, this sounds very narrow, but the implications are as broad as you can imagine. There is a feeling that when you head into a downturn, you invest in duration, you head into long-term government bonds of developed nations, certainly what's happening in the United States. Are you saying over in Europe and perhaps in the U.S., that is not the correct trade, that you're going to see yields on the longer end, on longer-term treasuries and gilts and boons go up, not down into a downturn?
Well, Lisa, if we're not at the top of the Fed tightening cycle and we're barely approaching the top of the inflation cycle, bond yields are going to go up with or without QT. It's just a question of how far. So the QT makes the bonds look less desirable. It also raises the rate on long-term lending, and that in turn depresses the economy because it discourages borrowing to invest. It discourages, we've already seen it in the housing market and mortgages. So yeah, long-term interest rates are probably going to go up from here. That doesn't mean the yield curve can't be inverted and that it can't continue to be inverted. And it certainly doesn't mean, anything. We're still going to get a recession at some point, although maybe not right away. But we are going to see higher long-term bond yields.
Okay, so for how long? And I ask this because a lot of people are saying that the Fed does want to bring inflation under control, so does the ECB, and they're going to inflict quite a bit of pain in order to get that. Are you saying that they don't have the conviction to do that, or just that all of the financial engineering over the past couple of decades is coming home to roost, and that long end will continue to go up for a longer period of time with higher real yields?
Well, Lisa, I think that this whole process has a finite end. We saw a massive surge in the supply of money to the economy, and we've had too much money chasing too few goods, and that's giving us the rise in prices that we perceive as inflation. But I don't believe that's an infinite process. I believe the adjustment of real money is being undertaken both by central banks and their QT, combined with rising prices, eroding the value of the nominal money supply and bringing down real money. In short, all right, it's a process that has a finite endpoint, and by our calculations at High Frequency Economics, we have some great charts on this for our readers. We expect that most central banks will have gotten money supply back to where it ought to be for price stability within the next year, and that a year from now we will be talking about the recession and hardly talking at all inflation. But we have to get there first, and we're not quite there yet.
Carl, you read on the stochastic nature of inflation. You look at the two bouts after 1947 and on and on and on. The pointedness of it, up we go, high inflation, we turn around and disinflate rapidly. Is that your scenario?
I don't think we have to see disinflation, all right? We've had, again, you look at the chart of money supply in the United States, and I hate to sound like a monetarist because I'm not one, but you got to look at this chart, Tom, and you see this big bubble of money being printed, and there's just too much money out there, so we have to wear that off. And a one-time increase in money should lead to a one-time increase in prices, and it feels like inflation when we're doing it, and that's where we are right now. We're just prices. But it doesn't go on forever, all right? And we don't have to see prices fall from here. Just they'll stabilize at a higher level.
Let me go Milton Friedman, David Laidler on you as we go monetarist. Where does that money go if we have a balloon of money?
Well, first of all, the Fed takes a lot of it back with its quantitative tightening, and that's what we're starting to see now. And that's what we're going to see in Europe on Wednesday morning. We're going to see a big step toward reducing the money supply in Europe and getting it to where it should be within a year. And the other place it goes is that rising prices make the real money stock, the amount of goods and services that the money can buy, all right, become less. So therefore, all right, we then adjust the amount of money we have to the amount of goods and services we're producing. So the money doesn't disappear, but real money gets eroded by the rising prices, and the central banks do the right thing, which is what they're doing, which is start to take it out with quantitative tightening.
This right sizing of monetary policy, what does that do in terms of the depth of the recession that you're predicting?
Well, the recession itself, there are a number of factors behind the recession. Some of them are just cyclical, all right? Some of them, the biggest component of it, though, is that I believe that wages have not kept up with prices. That, by the way, is your clue that the inflation is not going to be self-sustaining. And we have real incomes coming down. So we have probably a pretty powerful recession coming. We also had a pretty powerful boost coming out of this wonky recession that we just had. I mean, reread Jay Powell's speech at Jackson Hole, not last summer, but the summer before. He says, this is the darndest thing I've ever seen. We had a recession and incomes went up at the same time. How could that be, right? We've got a lot of excesses that we have to purge. So I think we have a sizable correction in the economy to come. I can't put a number on it right now, but I think it's going to be a pretty substantial one. It's not going to be a little one.
Carl, what's your theme for your 2023 outlook? Give us a window into that.
I think we're going to morph our concerns away from inflation. Prices will stabilize, and then we'll be thinking more about the recession. So it's a pivot in your language, all right, a morphing of focus away from inflation as prices stabilize.
Carl Weinberg, thank you so much. High frequency economics, just a terrific brief. And even there, Lisa, we've got to have Dr. Weinberg back because we didn't even get to one of his fortes, which is the emerging market fragilities that are out there. Friday, look for it, folks. Abramo, I'll be off Friday after surviving my cooking. Bramo with Damien Sassower. What an inspired pairing.
Well, I love that I'm with Damien because you guys all ditched me to go enjoy your second day of the Thanksgiving holiday. But Damien's going to be the trooper that comes in here, and we're going to have a great time. We're going to talk to all sorts of strategists and focus on fixed income and talk about what's going on with the shopping. Are you going to do shopping?
No, it's England-U.S., I think, Friday. I can't remember. There's a big game Friday. John and I have already picked out a bar. He says I have to go below 59th Street.
Yeah.
So, that's what we'll be
Good
doing
luck.
Friday.
Have fun. And we hear even more people clicking off. I do want to just point out one thing. And Carl Weinberg was talking about the year ahead and what do you get if you pull out all of this extra money that central banks pulled in.
Fair amount of gloom there.
So Morgan Stanley put out their outlook and talked about where they disagreed the most and where they had the most heated disagreements had to do with
Steve
the housing
Roach
market.
101.
And this to me was fascinating that they really had a controversial moment where they think that there is going to be a massive decline in the number of sales, but there isn't going to be a huge decline in prices. This is one of the big distinguishing features. People think that there isn't going to be this massive housing rout, even though you've got 7% mortgage rates. And to me, this is one of the biggest question marks because this is the first area that really feels how much we've jacked up rates and what the consequences
I strongly agree with this. And first of all, in our prism here within 3 zip codes of New York City, we don't know what we're talking about. Let's start with that. But the bottom line is they're dead on in that housing is a huge part of the economy, a huge part of inflation, OER, and all that is hugely behavioral. To me, it's underplayed. It's not just about statistics and cold math. And just like you say, people are going to see an X% decline in their house, and they're going to go, let's sit on it.
Well, and where else can they move, right? If borrowing costs are where they are, there's going to be no inventory, which is what you're seeing now to some degree.
Shout out to Stephen Roach, who invented modern Morgan Stanley economics, which has always been visibly fractious, and we think that is a good and powerful thing. It's like me and Bramall. We haven't agreed since 2017, I think. Stay with us. This is Bloomberg Surveillance.